Hello everyone. Before we start with the video, I want to say a couple of things. I am not a financial planner nor a financial advisor. I'm not FCA approved. I'm not approved by any institution that allows me to give financial advices. Nothing mentioned in the video should be considered as an investment advice nor guidance. Everything showed, talked, and explained is for pure and only educational purposes. The risk is in your own hands, and I always recommend trading on them accounts as that's literally the only way to not lose money in this market. Enjoy the video. Hello guys, good morning, evening, afternoon, whatever you actually are, or whenever you're actually watching this video. This is somewhat of an intro, as I realized that on the full video I actually never did an intro, because I actually recorded it separately, and now I will put it together. So yeah, basically, I just wanted to say that I hope you enjoy. It took a lot of time, a lot of tries, on each of the on each subject per se. So that was a lot. I think I've talked about a lot of concepts, a lot of things that are actually going to help you in your journey. Of course, I'm not a professional, so I do think that you have to take everything that I say with a grain of salt, as I can be wrong in a lot of things. There are things that I haven't mastered. There are concepts that I don't even understand that I apply, but I don't understand, and those are things that I've actually come to realize basically thanks to this video. So the best way to learn is to teach. Well, not the best way, but it's a pretty good way to learn when you actually try to teach someone else. So I do think I've gotten some pretty good value from making this video. I I think that's basically it. I hope you can get as much of it. I hope you watch it more than one time, as some of the concepts are going to be a little bit hard to understand the first time. But the thing is that you gotta watch the video, go on your charts, find the stuff, the concepts that I've taught you on this video, and basically, yeah, just apply it, practice, and that's what will give you the consistency that you are all looking for. I hope you enjoyed the video. I hope you take as much as you can from it, and please make sure to share it with anyone that may need it, and make sure to leave some commentaries about anything that I can improve or change for any video of the future. I'll be seeing you soon, guys. Okay, now we are going to be talking about we're going to be talking about the supply and demand slash smart money concepts. And I gotta say something before we get started with it. And the thing that I want to say is basically that I have really not much of an idea of what to say about supply and demand or smart money concepts. So, as I don't want to misinform you or say stuff that may basically um, mislead you to doing something that might not be beneficial for anyone. I won't be talking about concepts themselves that I basically don't understand, but basically I will be talking about concepts that I use on a daily basis, such as supply and demand flips, liquidity, and liquidity. Most of what I'm going to be talking about. And I did get asked to talk about um, the flip zones in higher time frames, and I'm going to start with that because I think that the flip zone, or sorry, the flips, and yeah, anything related to a flip was basically misunderstood or misinterpreted by basically a couple of people, a couple of persons, and basically there is no area that can be called a flip zone. So if we go, let's say, to the 1 hour, and I can't say, okay, so this is a flip zone, this is an order block. right? This even though, as an example, here we have a flip, and let me actually find something here. Okay, so we have an area here. This is a range. I've talked about this type of structure. This is a range before a major break, before a flip in this case. So this range is pretty important, and as you can see, price actually reacted to it, right? And after that, we do get a small break, but in my opinion, actually more than enough as to the flip. And even though this zone caused a flip, that's not a flip zone. It's at least as far as I know, and of the concepts that I actually use, there is nothing like a flip zone. So the concept that you see on my charts, when I say that we have a flip, I wait for a flip, then I wait for a break of structure. A flip is basically, so what I understand of supply and demand is that a bearish market is a supply market, right? So basically the sellers are winning as they're showing more strength than the buys, right? And you can see that by basically the moves. We have lower lows, lower highs, lower lows, lower highs. And if we are in a bullish market, for me it's a demand market, and basically it will be that. So this will be called a supply market, and this will be called, let's do it from here, this will be called a demand market, right? So that's what I understand personally about supply and demand. That's what I use to basically say, okay, so for me, as simple as this is a flip, right? And this is no longer a flip, but it's just a break, right? It's just a continuation. We were pushing higher, creating higher highs and high lows. So the break of a high is just a break. Now if we are creating lower lows, lower highs, lower lows, lower highs, and we actually change that to higher highs and high lows, then that break that caused that change from supply to demand is basically a flip. That's what I understand as a flip, and of course it's more important than just a break, but of course it can depend on what you identify as a flip or what you identify as a break on your own strategies, right? So basically, and let's do another example with a flip to the downside. So it's basically something, oh, what did I touch? Okay. It's basically something like this, right? So as simple as that. We then change to a supply market again, right? So here we have that D2S flip, demand to supply flip, and that's very simple. As I understand, this is a concept that they are teaching now in Phantom, but this is actually a concept that I was not there when they basically started using these concepts, and I kind of learned that by watching their trades and watching what they were doing on their charts. So this is a flip, this is a break, this is a flip, this is a break, a break. If we had another thing like this, that's a break. So when does a flip happen? A flip happens when we have a flip from demand to supply or from supply to demand. And you have to know so you basically have to know the basic concept of higher highs and higher lows. This is a higher high as it broke the previous high. This is a higher low as it is higher than the previous low. This is a higher high as it broke the previous high. This is a higher low as it is above that previous low. And this is a higher high. This is a higher low, higher high, higher low. So when does a higher low become a higher low? When that low when the movement that is created by that low breaks the next high, right? So let's say we have something like this. Let me actually try and draw something really nice right here. So you're pushing higher, higher high, higher low, higher high, and you have this structure. This is not a higher low, just for now, right? And this is not a flip, right? That's not a flip. Right now we have broken this. This is a break of structure, but we have not flipped. And let's say we then get something like this, which is do that and then push lower again. This is not a flip either, right? And we have broken this structure, but let's look at it like this, right? So we have this structure basically, right? This is our high confirmed high, and this is our confirmed high low. This is our confirmed high, and this is our confirmed high low. This high has been broken, so it's not important anymore. Now we create a structure, a swing low. We create a swing high. We create a lower swing low compared to this. And on a situation like this, that's a flip, because this low is a confirmed low, but this low is not a confirmed low. It's not a confirmed higher low, as it didn't break the high. And then we have that low gets broken again, and this low is not a confirmed low until we break that confirmed higher high. Okay, so whenever we actually do this, whenever we actually break this confirmed high, then that's when we have our confirmed low, right? And that's when this area is basically useless. We don't use that anymore. Okay, so if we then get something like this, this is our confirmed high, as we have broken that high, and then this is our confirmed low, as we have broken this high. Okay, and if we had something like this, where we had this and this, then our confirmed low is broken. So this is now a flip. Okay, we're not counting this one anymore, because this is our newest, or newest. I don't know if that's the actual word, but I think you do understand that. Our most recent confirmed low, and that was broken. So this is a flip. And if we then get something like this, this is a flip, as this is our new confirmed lower high, and this is our new confirmed lower low. Okay? Okay, sorry for the pause. So, I think the structure, or the way that I identify flips and breaks, is well understood by now. So that's basically what I identify as a flip against just a break, right? So it's based on confirmed lows, confirmed highs, and it's something that, as an example, I identify this just by looking at it, that this is a flip, and this is just a structure break, right? So we do have a high, a low, a high here, but if this higher high was here, this is not a confirmed higher high, because this is all that is happening between the confirmed high and the confirmed low. All that's happening between is just substructure, right? So you're not really counting on it. As an example, sometimes, depending on what's going on, this, for me, this right here, this right now, could be a trade for me, right? And that really depends on if we are in somewhat of an area, or if we have, let's say we have this structure is something like this. Let's draw with that. So we have something like this. So we got to this point, and now we were retracing, and then we basically get all of these potential confirmations to take a buy. Maybe that's an opportunity, or a time where I would actually take such a trade. But if we don't really have a confirmed flip, then for me, most of the times, it's just not an entry. It's not a trade for me, right? So yeah, that's the difference between a flip and a break. And yeah, okay, so I'm trying to see. Okay, so I wanted to talk about liquidity now, which is basically, I feel, in the same subject. And liquidity, it's a little bit hard to explain, but liquidity is everywhere. Every high and every low that you see is basically liquidity. Literally every high and every low. So this high has liquidity, this high has liquidity, this low has liquidity, this low has liquidity. Well, it was taken, that low was taken, so that liquidity is gone. We do have liquidity below this area, and so on and so forth, right? So we have areas where the liquidity will be stronger than other areas, and we will have areas where the liquidity is weaker than other areas, right? So a liquidity such as this one that we have right here, that is basically some really clean equal highs, in the 1 hour is of course stronger than the liquidity that we have on a 1 minute, right? We could have 20 equal highs on the 1 minute, but equal highs on the 1 hour is going to be more important than those in the 1 minute. And that's just simple higher time frame structure. I don't really know how to say this. So let me just write it. So higher time frame structure better than lower time frame structure. Not better, but stronger, basically, right? That's the most simple thing of Forex. So what is liquidity? Liquidity, as I was taught, is the market creating, manipulating the market. So not the market, sorry. The banks, the institutions, and banks and institutions basically manipulate the market. So retail traders place orders on those manipulations so they can take those orders and then move the market as they will, or something like that. Okay, so take everything that I say with a grain of salt. I think that's the expression, because I don't really know the concepts, but I know what's liquidity, right? So that's what I really want to show. So what is liquidity? You have to think like a retail trader thinks. You have to think on matters of support and resistance and equal highs, double bottoms, double tops, and stuff like that, right? So as an example, this that we have right here is a typical manipulation where we have something like this that most could identify as an area of support. So someone could easily do this, right? I hate the colors, I really do. Okay, so we have this that basically we have a potential trade here, right? So we see the support, then basically reacts to it again, and then we have the potential opportunity to take a trade here. And as you can see, price goes right through. And we even do get a rejection. As you can see, this candle, if we go, let me actually replay on this and go on to the 5-minute time frame, we do get a reaction. We do get a reaction from that. Price does find a good reaction, and even then does react a little bit as it's basically reacting to something down there, right? But as you can see, it later does break that structure, pushing lower. Okay, so there we have the first stop loss, right? People have their stop loss just below this area that price is failing to break, so they think it will hold, and price goes straight through that, right? And what's the next thing that could happen? What are the next type of traders? The break and retest traders, right? So you have that, now we've broken the structure, so you wait for confirmation to take the sell, right, onto this area. So break and retest. That's actually a strategy that I used to trade with. So what do they do now? They place a trade here. Hate the colors, but it is what it is. And they look for something like that, right? Maybe equal to this move. So we have 70 pips. So we go for 70 pips, right? So almost a 1 to a 9. A 1 to a 10, sorry. And what happens later is, let's say you do have a higher stop loss or something like that, and price will just come back up. So what happened now? What do you trade now? Then you wait for this structure to be broken, or for this to be broken, to basically try and get into a sell. Or maybe you could think that price is now creating resistance here, and you will wait for price to actually continue to fail to break that and take a sell here, which is a valid trade. And what happens later is that price actually continues to go lower as you were expecting for it to do. And now we broke this structure, so you wait for that trade, and that already fails again, right? So liquidity are those stop losses. Liquidity are those orders of retail traders, right? Our stop losses. So when you see support and resistance, support or resistance, when you see equal highs, such as this ones that you have right here, when you see somewhat of a range or something that looks that can't hold, such as this, you have a whole area that price can't really break through. Then what you identify that as is an area that price can't break through, so you can easily go up. And you get 1 reaction, 2 reaction, 3, 4, 5, 6, even a 7th, and you say, okay, so this is a trade. You take it. Let's say if you were lucky and you went for a 1 to a 5, then that would have been a target, right? Because, well, actually now, but let's say you did get lucky and you got into that trade. But if you weren't just to these highs, which is a pretty valid target, you would have gotten stopped out, right? And all of this area that you see is failing to break, price out of nowhere just does that. And that simple move is just manipulation. It's as simple as that. When I see this, I don't think price is failing to break this area. I see it as institutions and banks just creating an area so retail traders place their orders here, their stop loss is just below that area, and then they take that liquidity. What you could see sometimes is that they take the liquidity and then continue to go higher as they want to take the retail traders out to then continue in the direction of the retail traders, such as this scenario, where you create a resistance area that you're trying to show that price is basically failing to break through that. So you're showing an area that basically has some kind of strength and price can't go through. So you basically place your trade here. The stop loss, let's say you place it here, and price comes right through that area and then continues to push lower, right? And then you had another resistance area and you see this reaction. So you say, okay, so we actually have a pretty good area now. We got stopped out. So the direction was actually the buy. So you place your entry here, stop loss here, and you take that buy, right? And that buy, what happens? Price takes this liquidity now, right? And you say, okay, so we have a break, so let's go for the retest. And the retest does not work. Does it go to the upside? No, it just went to the upside to take you out and then continue to push lower. That's manipulation, that's liquidity. There are a lot of concepts that I use that I don't really have the actual concept, so I don't really want to give bad advices, right? So that's the reason why I'm not being so specific with some stuff, right? And as it happens on the 1 hour, happens on the 1 minute, and that's not something weird. It's not something that you see every now and then. You see it all the time. There was actually a pretty good example. I think it was before this day. And even all of this, just all of this you have right here, this whole range that price is failing to break above, failing to break below, that's just liquidity above and that's just liquidity below. So if you have a clear direction of the market, if you have this, the knowledge that this is liquidity and this is liquidity, then if you know, well, not entirely know, but if you think that the higher time frame structure is saying that price is going to go higher, then you look for a trade based on this liquidity, based on the fact that price can easily break through this to then continue to go higher, because it has reasons to go lower as it has reasons to go higher, right? It has liquidity on both ways, both sides, sorry. So let's say you were lucky or you analyzed correctly and you have this entry. So you have this area, this is a pretty good area, and as you can see, we can even go lower. And look at this is just equal lows. I mean, they're literally in just that line. It's as simple as that. You find liquidity everywhere. And it can be as beneficial as it can be, well, contrary to beneficial, of course. Because you might think that this is liquidity. Well, it is. But sometimes price will, let's say you have the break to this range, and price will do this. It doesn't take that liquidity. Sometimes it will take the liquidity, sometimes it won't. Most of the times it does. And it later did, as you can see, right? It's just that. That's liquidity. That's as simple as that. So having that in mind, you can think, okay, so we have potential sells. This area, this area has all of the liquidity just below it. So this could have been an entry for you right here, basing on the fact that we have an area that caused a major break and an area that basically has liquidity even inside of it. And then you have this other potential buy, basically this range that we have here, or maybe if we are in the 5-minute time frame, this is probably a whole area. And it kind of, I don't know, no, it actually doesn't react to the 50. But basically, you have that this area takes all of this liquidity, including this one, right? So that's liquidity. That's liquidity. That's what moves the market. You'll find liquidity everywhere, even inside of these ranges. So let's actually go further to see if we can spot anything. Right here, we have liquidity right here. That's liquidity. We have liquidity here. A couple of equal lows. That's liquidity. Where else? Well, we could call this liquidity, although I do like them to be a little bit neater. But look at this. It's literally on the same line. If we check right here, you're going to see a couple of numbers, so check those. Oh, actually not. Huh. I probably disable it because you can see what, okay, this is the one. Yeah. Okay, look at this. So the L is for the low. That's what we're interested on. The low of this candle is 37,819, and the low of this candle is 37,819. So those are equal lows. That's liquidity. We could have identified just like this. It still is liquidity as a couple of clean equal lows, because if you're a retail trader, you could count this as your whole area, right? That's your area of support or resistance. And you could try and trade with the stop loss just below this area, and price comes and take it. And same thing here, we had liquidity, price comes and take it. I mean, even within this range, you have opportunities to the upside, to the downside. You have liquidity here, then you can target that. This area took liquidity, so this is a pretty important area. You can try and sell from this, right? So you say, okay, we got pretty clean equal lows, so let's take a trade here. And that small move that we have right here, this order block, basically took this liquidity and then caused somewhat of a break and created equal lows. You have this entry just going for the open. Stop loss, let's say 11. For me, it's 5 ticks extra for spreads, and I would have gone for 75 as it is the 5-hour ratio, right? This will be my usual target. Now, if we do have this liquidity, if we have liquidity to aim for, I have had these kind of trades where you just aim at that liquidity, and price takes the liquidity and then goes higher. If we go even into more detail, this is liquidity. And the area that took this liquidity caused later a break, and well, price actually didn't respect that area, but basically have liquidity right there, was taken by that, and then a move down. I mean, I don't think I can make it simpler than that. You can see it everywhere, and I'm talking about actually clean liquidity, right? Because this that we have right here, let me get my, where is the curve? Is it? I'm not sure if this is the one that I'm looking for. Yeah, it is. So this is liquidity. All of this, even though it's not straight, all of this is just considered as liquidity. And even though it doesn't actually cause a really strong move, as you can see, when price takes all of that liquidity right here, it pushes higher and then breaks. And we have liquidity here, breaks it, takes that liquidity, pushes a little bit higher. And then we have liquidity under this low, above of these highs. We have really clean equal highs here, as you can see. This is liquidity, this is liquidity. We could even consider this as liquidity. You gotta think as the simple fact that some strategies tell you, okay, so you have something like this range goes, you can try and trade that, and that is basically liquidity for you, for retail traders, sorry, for the banks and institutions. So a small pause like that could be liquidity. So because someone could understand that as a potential area of rejection later, right? And some of these concepts might get into your way in the way that, well, this was beautiful. This is a little bit bigger liquidity, right? So that's why it causes such a move. So price takes that liquidity and then continues to push lower. That's liquidity. It's as simple as I can make it, and that's why, sorry, not why, but how I understand it. And on Friday, there was a trade that I sadly wasn't triggered on, which is the one that we have here. And it generated liquidity. Look at that. I mean, it's just crazy. Also, an area or a candle that takes liquidity and then creates an impulsive move. This one bottom. We have the break, and this break was basically caused by this whole the extreme order block, and that extreme order block took this liquidity, right? So I was hesitant of this trade, but then look at what happens, right? I wanted to take it on the 25, I believe, because, yeah. And again, actual equal lows. The low of this candle is 21, the low of this one is 21. So that's equal lows. So that's inducement to the below, inducement bottom, and price comes, takes that liquidity, mitigates this area, and starts to push higher. Look at the move that it generated. Of course, then you got this weird thing that we have. I don't know. But yeah, and if you see this move, it took, you could say that it took this two lows liquidity, which looks like it clean equal lows. You can say that it took this. You can say that it took this. You can say that it took those, and you could continue. You could even say that it took that we have right here, right? And then started to push higher. We have liquidity above this high, because imagine being a trader that trades support and resistance and see such a reaction out of nowhere. What do you think is going to happen? He's going to say, okay, so this area is just an amazing area, and you place the trade just above, and that's more liquidity. Understanding liquidity gets you on the right side of the market. And this, as an example, here we have a case where it would have played against us. You have a range, right? You have a range. That range causes a break, and this is a potential entry, right? But that range has liquidity. So you can here either take the risk, as it does take liquidity from above, so this is an important area now, but it has liquidity below, so price could do this and then go higher. Thing that you could do, take the trade here, stop loss a little bit higher, just to cover the potential move to the downside that it could cause to take that liquidity and maybe be able to target it, or you just don't take it, wait for something else. As an example, the break that we have here was caused by this. You would have gone for something like this, so you would have been missed. And as simple as that. In this case, me seeing this liquidity, I would have missed out on this trade. And it also happened real late. And you could also, ranges will always have liquidity, but sometimes you have something like this. You have this, you have equal lows there, a low there, price does this, and then breaks. And sometimes you get somewhat of a pause here, and then it breaks. And the entry is that, not the extreme, even though it has a lot of liquidity taken, and sometimes it just goes for that pause. Right? So this is the kind of ranges that I like, the ranges that take liquidity. And if we go to this trade down here, this is not somewhat of a complex pullback nor a range, but the whole thing does look like a range, but this took liquidity. And when you think about it like this, you're trying to take this trade. You have liquidity just above the area, right? What do you think? Price has to come back and take this liquidity. This liquidity was already taken. You have liquidity lower? Yeah, you do. But you can, if you do, so this is liquidity, right? So the way that I do it, even though I see liquidity everywhere, this is liquidity, that doesn't mean that I couldn't take a trade here, because of course every low, every high has liquidity, right? But I take what I think of important liquidity, because if you think that every high and every low is liquidity and you don't want to take something that has liquidity, then you literally can't take anything, because this is liquidity, right? So this is a trade that I would have missed if I didn't want to take something that didn't have liquidity. But we have that it took the liquidity that we have here and then generated some of liquidity to then mitigate that and push higher, right? So yes, every low, every high has liquidity, but you have got to think on the higher term, right? It's not that you're going to miss every single trade that basically happens just because of that. But yeah, I think I've illustrated what liquidity is. I hope that works, or that helps you out a lot. This is an interesting example that I was basing on liquidity. I didn't like the entry itself, wanted to go for this. Wanted to go for this after I saw that we had liquidity. And basically, as you can see, it never really mitigated that. Of course, it does later. And it does respect the order block, doesn't it? Barely does. Took that liquidity and even fell a little bit. So it's just as simple as that. can be a little bit complicated to find it first. But when you put in the work, you put in the effort, you put in the hours, it comes easy and it becomes easy. And knowing those concepts, knowing what's liquidity and what price might do based on that, really does give you an advantage over other traders. You have liquidity here. So yeah, that's all about liquidity. I gotta make a pause just for a second, but I'm not really sure if I'm going to talk more about any of this subject. But yeah, be right back. Okay, guys. So continuing with the video. Sorry for the pause. For you it was a second though, but for me it was a couple of hours. Something that I forgot to add on the how do I trade section was how do I actually take a trade, because well, the important thing is actually uh, the entry, right? I think that's the actual thing that matters, as if you choose the wrong entry area, you basically either take a loss or miss out on a trade, right? So let's get on to that. My entry areas are order blocks. What are order blocks themselves? Like the actual concept, I don't know it. But it's basically a candle just before a move, right? So as an example, this that we have right here is an order block. And actually, this is the order block, right? This huge black candle, right? As it is the last sell to the buy. So the last candle before the impulsive movement. But something that I always thought in Phantom is that when you have such a big order block, basically, and the next candle actually doesn't engulf that order block, you go for this, right? So that's why, as an example, in this case, I went for that, and basically it does tap that very late, but it does. And if it would have gone for the whole candle, well, does it mitigate the 50? Let's actually see. Oops. It misses it by just a few ticks. Okay, so that's where I take my entries. An order block. What's an order block? It's so you could say this candle right here is a sell just before a bullish movement, right? So you could think that this is an order block. And you're kind of right, but at the same time you're not, because as I identify order blocks are that exact same logic or concept, but basically what has to happen next is that order block actually causes a break, right? So what I expect later is for price to actually come back and mitigate that order block, to basically mitigate some some orders that were left. That's what I basically understand of an order block, right? So that's my base type of entry, right? My default type of entry, order blocks. The next type of order blocks, actually now let's go to how to choose an order block. And to be honest, that's the hardest thing to do, as you have a lot of options. You will have a lot of options. You will have to choose either this or that. And it's not easy because, as an example, let's say I really want to look for something. Well, here, I mean, as an example, this comes a little bit with logic at some point. This whole move, if you're trying to buy it, I couldn't really say for sure where I go. The only that actually makes sense is either this pause right here, or this, which is basically the extreme, but has somewhat of a pause just before the move, right? Which is what ended up working. And then later it will be this, as you can see, because we have this move basically that causes this break, and there's no other cause in the extreme, right? Sometimes price, as an example, reacted to nowhere between a lot of commas, because if we actually check this, it reacts to that order block. I thought it did tap the 50, but apparently it didn't. So yeah, choosing order blocks is pretty hard. And for me, most of the times, I go for the one that has the most confluences, right? So I usually go, as an example, here we have somewhat of a major break. And that major break was caused by this. But up here, what do we have? We have liquidity from this high, the entry that it kind of does look like it basically comes from mitigating this other area that we had right here, which is a pause on price. And basically it does look like a good trade, right? So you have the choice to either go for this, which is the cost to that break, to a major break in this case, or you can go for the extreme that basically caused the whole move, right? And to be honest, sometimes I go for the extreme. Most of the times I go for the cost, right? So as an example, it also depends on the setups. I think this section is going to go first. I still don't know where each section is going to be on the video. That's why I'm thinking. So you still haven't seen the type of setups, but when you see the type of setups, as an example, here we're going for the extreme because this is the setup number 2, continuation, right? So basically that's why I would go for this and no, not as an example this, which is the cost of this break, and it kind of does work for a little though, but yeah, you know what I mean. Here we have a flip, right? We have a flip. The cost of that flip is this. I'm not going for that. As you know, I don't go for just one flip. Plus, we are kind of reacting from a bullish area, so basically, yeah. We have a flip. Have a couple of weeks that basically cost that flip. We even had liquidity here. I'm going to move it just so it doesn't get in the middle. We have the flip. Price goes up, mitigates something. If I would have gone for this flip, the area that I would have gone for is this, as it's basically the cost to the flip. But at the same time, if you actually look at it, okay, let me actually just hide all this. How can I hide? Okay. So if you look at all this, you have that this is our flip, right? And what do we have just before the flip? A pause, right? Literally just before that flip, we have a pause that basically went a little bit higher, and then as soon as it began, broke, and then we have price coming higher, and it does basically. I can actually get into seconds. Okay, hold on, because we could talk about this. I forgot that I had premium already. Okay, so I don't know how much can I replay with this though. Where was I though? Here, right? Yeah. Okay, so here I'm actually getting a little bit deeper because all of that structure you can understand it right there on the 1 minute, but on the 15-second you actually see it. Okay, I'm not saying that you actually need it because I was able to spot it on the 1 minute, right? But this is what we have. Sorry, that's not the one. We have, this is the pause that we see on the 1 minute. And the cost to this whole thing, to this break, to this flip, is this whole thing, right? So let's actually say we go for the 50 of that. Like that. Is that, yeah, 50. So just like this. Stop loss is just above the top of this candle, so it's 14 ticks. Let's call it 20 ticks, which is 2 pips, and a target of 1 pip. And basically, this that in the 1 minute is just wicks, you actually see it as candles here, right? And price goes up, mitigates that, and basically falls, right? I'm not saying you need the 15-minute time frame, the 15-second time frame, sorry. That's not necessary at all. I do not use it or for anything. Now that I have it, well, I may do something like that as an example because I do remember a case where I did have premium, and what we basically had was this, not the sell. Okay, here. See, so we even had a better entry than if we would have gone for this candle in the 1 minute, right? So I did have one time I had somewhat of a range that was just 2 to 3 candles. It wasn't more than that. So we had this candle, and this candle, right? This was the whole range. And as you can see, we had somewhat of equal lows here, and this week was taking that liquidity. So I went into the 15-second, and what I had was a range like this that basically had equal lows, and the range had mitigated those equal lows and then continued to push higher. So for me, there's no longer liquidity here. So this is a pretty valid trade. This is a strong area, even though that was cost on the 15 second. And that trade actually worked out. I don't remember if I took it, but I do remember it worked out, so that's great. So it's as simple as that, right? I usually go for the cost. That's what I go for. So we have a flip, we have a break. The cost to that break is this entry. It's this order block. As you can see, we don't have any other area. And then we have the break, which is the cost to this. And as you can see, it does mitigate to 25% of that. It doesn't hit the 50 sadly, but yeah, it is what it is. Then we have the break, and actually here again, you have I could call this a major break, but it's not necessary. And this is what you encounter. You have a very small break, right? You then have a pause. So at this point, you could be thinking about going for this or just this extreme, as this has a lot of liquidity, or you could basically just place an entry here on the 50, sorry, on the open on the 50 of the or the 75, and basically having your stop loss just above this liquidity, just in case price decides to basically mitigate that and then continue to push lower, right? But it immediately breaks down. And again, I do think that we could see this a little bit better in the 15 second. But what we have here is a minor break that, if we think deeply enough, we can say that this is not a break. Then we have a pause, and then we actually get the break, right? Or in another case scenario, we could call this structure as a low. So this is a new break, and that new break was caused by this pause, right? You could go into that type of details, because if we now head to the 15-second time frame, what do we find? Structure. We find this is an amazing break. This is a pretty complete break, right? So this area right here is an amazing trade. This is a lovely trade in the 15-second time frame, right? What in the 1 minute time frame didn't look good. Oops. When the 1 minute time frame didn't look good, here it looks like a whole different structure, right? Price mitigates that and then falls, right? So if we head back to the 1 minute, as I said, you can either count this wick as that break, then you have a pause, then you have another break, and you go for this, or you can count this whole thing as the break and then comes back to mitigate, right? And even if you were not using the 15-second time frame, you take the entry just like this, because you see a pause just before the break, and basically the entry wherever you want it to be, 25, 50, whatever it is. And always keep in mind the wicks. The wicks are a pain in the ass. You can get wicked out because you didn't consider a wick or just a small area that wasn't mitigated on a previous range, and that can easily fuck up a whole trade. And believe me, it's not funny. It's not funny. It's not yeah, it's not good. But yeah, you'll learn from those mistakes. You know, you gotta learn somehow. So that's how I base my trades. So how to choose? I wanted to talk about order blocks. I already did. Entry areas. I think I've made myself clear. As an example, so I take order blocks, I take pauses, I take ranges. So if you ask me a range type of entry, I don't know if I can find anything pretty. Oh, well, actually, no, that's not a good example. I actually see though, because it might be. Well, as an example, this is a range that I would like to trade, right? The range doesn't leave liquidity, because what you have it, or this range is just lovely. But there was this one. Okay, so here is what I see here. We have a range right here. Price doesn't move for much more than that. And then we have another range just before major break, right? What does that say? This whole range is just a small pause for price to continue to go higher, right? It's as simple as that. Because when price is pushing strongly to the upside, sometimes it just corrects and continues to push higher, right? That's usual structure. I mean, if we pull away or go through 3 minute or something like that, you have that. You literally see it everywhere. Push, range, push, range, push, range, push, range, push, range, push, range, push, range. Right? That's what the market does. It's just no usual structure, right? And inside of those ranges, you find other ranges, right? So as we have, this is a range and this is another range, and we could even call this as a range, right? Even this, it's just something that this is a range. It's just when price decides to pause to then make a push, right? So this range that we have right here. So let's suppose we have something like this. Let me draw an example. Okay, so we have something like this, and we are expecting a trade here, right? Okay, so we have an area, right? We have an area. We're trying to, let's actually say the area is this, to not always go with the extreme. Okay, yeah, that looks better. That's the area where we want to trade. But let's say I don't entirely like how it looks. I do not want to place a trade just because we have a break, and I don't want to take it just because we have a break and the cost of that break, right? Let's say I don't want to do that. Okay. So instead of placing this trade right away, what I wait for is for price to basically come back. Let's say create somewhat of this kind of a structure, pushes higher, the entry works, starts to push lower, this gives a mitigation, breaks this structure, and for me this is an entry, right? It will be some kind, so this will be the confirmation entry or maybe the risk entry, and this will be the confirmation entry, right? You basically waited for price to create one movement and you basically took the next one, right? So what can happen here is that price can easily range, right? So let's suppose we have something like this, ranges, boom, it breaks. And this whole range for me is an entry. Sometimes it'll react to a candle that is here, sometimes to the extreme. It doesn't really matter. I usually, when I have a range like this, I go for the 50% of the whole range, and that has worked out for me. So that's what I recommend doing, right? So if this range was actually happening on an important area, I might would have gone for that, right? It does cause a flip. Sorry. Well, yeah, it actually does cause a flip. Took liquidity, so it's a pretty good range. But as you can see, it doesn't actually mitigate it. If we choose the high and the low, that's our entry. It does tap the high, but definitely something that I would have missed. So that's how I trade a range, right? I don't actually trade the range itself, but I try to get onto the continuation, right? You could try and let's say you have push, range, push, range, push, and you're inside of a range, and you could say, okay, so this could be the low of the range, and it probably will take liquidity, so let's place an entry here, or just market execute here. Price basically mumbles around a little and then continues to push higher, and you have your entry here. That's something that you can try and do. I find that a little bit risky, as price can range and literally just change trends. Of course, you have your stop loss for that, but basically, yeah, I prefer to wait for confirmations. So we have a big range. I wouldn't go for the 50% of this whole area, as it is a huge area. I mean, we have 10 pips, sorry. So yeah, and if I actually was to trade this, I would have gone for the 50% of this whole thing, and maybe the 25, as it is a pretty small area. So that's how I trade ranges. And then we have pauses. If you ask me where do I find a pause, well, this is a pause, this is a pause, this is a pause, really clean pause. This is somewhat of a pause, a little bit riskier though, but it's a pause. There was a trade that was actually based on a pause, which is this one. And as an example, I've seen a lot of trades work out when you have a major structure and the pause, sorry, and there is a pause just before that major structure. And I can't really say for sure this is a pause right there. The thing is, right, that this is a risky trade, right? It's not something that I would usually go for. This is not a trade I went for. So this is a risky trade, but what happens next? We have structure. This is not a confirmed lower high. This is not a confirmed high. It's just a swing high. This is just a swing low. This structure, this move that we have here, broke literally nothing, so there's nothing confirmed. So what is this? This is a break of structure. Simple as that. There's nothing more than that. So sometimes a break breakup structure for me is more than enough to take a trade depending on the context. The context says a lot. If you are doing this, right? Say you have something like this, and you have this break right here. This is not a flip. This is not a major break. It's literally just a break, right? If we do break this high, then we have a flip, right? We already know that. So if this is happening nowhere, then I could even consider this high as liquidity to take an entry here and expect price to basically take that liquidity and then continue to go lower, right? If this is reacting to something, then this break that we have right here is already a good trade for me, right? Or maybe in some cases, so it comes from this area, let's say, this entry is still good, even though this movement that we have here didn't cause any kind of break, right? So the context says a lot, right? Minor break such as this one, which is literally nothing. It's causing nothing. It doesn't change structure. This is substructure. It's breaks just within the major move. So it's literally nothing. But since it does have context, then you can trade this, right? You could have gone for the pause, which is the risky option, but a good option. Or you could have gone for the actual order block on the extreme that caused this movement, that caused the break, that comes from mitigating that, right? So you had two options there. You could have chosen, both were good, although if you went for this one and you enter on the open or the 25, going for 5R would have been actually a little bit hard to actually get. I'm pretty sure that you actually would have missed out on that. But yeah, that's basically it. And how to choose, I think it's as an example here. Oh, actually, I have a live example. So this is the area that I wanted to go for, right? In my opinion, this is the cause to this break. But what do we have? A small pause just before that break, just before this break, sorry, right? And what happens? I drew the area. I thought, okay, so that's a pause just before the break. But this is the area that I like. I don't entirely love it because it does have a lot of wicks within it. But that's another subject. But this is the area. This is the area that was basically caught my attention more than the extreme. But the extreme is what made sense. But I ended up taking a market execution on this one when we had this candle that you have here that basically rejected that area, right? So I decided to take it there, and well, it was a risky trade. I closed it earlier, so psychology wasn't on point on that one, but still worked out great. So yeah, it's not easy to choose. I mean, I suggest that you backtest, that you trade every day, of course with the demo, and you figure out on your own which are the ones that work the most. There might be a pattern, like let's say you have, so this is something that I could study or anyone could study. So let's say we have this. Let's say we have an impulsive market, right? We have an impulsive market, blah, blah, blah. And then we have a flip. And then we have a break. Let's say if we come from a strong market and we flip and then we break, then price will most of the times react to the extreme. This is hypothetical. I'm not talking about something that I know. So this could be case one, right? This could be how it works in that case. And then you have, I don't know, maybe a ranging market, right? You have something like this where price isn't that impulsive, pushing higher. And basically then you got this flip, reacts to this, and then you have a break and reacts to this, right? So what is the difference between both of them? This one does look like it reacted to somewhat of a pause or just small retracement within this move to the downside just before before the flip. And here we have exactly the same. We have somewhat of a pause just before the actual break, and basically, it mitigates that cause, which is probably a pause just before the break. Right? So what I'm trying to say here, that there might be a pattern onto which ones do work out better and which ones So which ones do work out better in certain occasions and which ones worked out on other type of structure, right? So what I'm trying to say here is that you could make this study, basically backtest or watch the market on a daily basis and try to find out if this is true or if it's the other way around. When we have rangy markets, then it'll react to the extreme, or when we have impulsive markets, it goes to the cause, right? I don't think this works like this. I think that every case it can react to either of them. Of course, it depends if they have liquidity. So if I have, let's say I wanted to trade this, and I have to choose. Okay, hold on. Let's say we have this flip, right? And then we have this break, right? At this point, we have the option to choose between this one or this one. Let's say that this move, Let's say that this move, okay, just like that. So we got a flip, we got a break. We got to choose between this or this. We can identify this as liquidity, meaning that okay, the recording got I hope that it actually let me actually check. Hold on. Okay, yeah, the recording was saved. Thank God. Okay, so what I was basically saying is that we can identify this as liquidity, and basically that would mean that what we will be expecting most likely is for price to take that liquidity, hopefully mitigate the extreme order block, and then continue to push lower, right? Or so that's basically what changes when you have liquidity. When you have liquidity, you can start looking at the one with higher probability, as this area could basically be just liquidity. But there's actually a trade that happened very recently that I don't think I'm going to be able to find, but basically it did exactly that. It created liquidity, but even though it did look as it was just liquidity, it ended up actually working really great, right? So yeah, I'm not gonna find it, and I don't want to lose time on that. So basically, that's how I trade. That's how I find my entries. That's how I take my entries. And of course, sometimes I don't get tapped in. Sometimes, as an example, if I would have gone with just that, I would have missed on this move, and I would have missed on then the rest of the move, of course. If I would have gone for the extreme in this case, it would have missed me. I really do like pauses or ranges just before breaks. So as an example, I do know that I would have gone for this. I drew this after, so basically when I came back after lunch and the market was already down, so I didn't really watch this live. So yeah, I mean, as an example here, I would have gone for the extreme because none of this makes sense to me, honestly. And there's another concept that is premium and discount zones, which is something like this, where you have, when you're trying to buy, you want to buy on discount, okay? And when you're trying to sell, you're trying to sell on a premium zone, right? So when you want to buy below the 50% of the movement's range, right? So of course we're talking about this range because if we consider the whole thing, right? If we consider this as a whole range, the only order block that enters is this one, right? And this one and this one. But everything above 50% is already gone. Basically, you are not trying to buy there, right? So that's premium discount zones. But basically, yeah, you could have applied that here and realized that so if it's in the middle, like a little near the 50, I don't like it. I don't like it at all. So I just count those as an area that is basically outside my discount zone in this case. So basically, I know that it would have gone for that extreme. I actually went for that extreme, but it just didn't get mitigated. So I think that's all that I want to talk on this section. I hope that it helped a lot. I think I talked about a lot of concepts that are very important, in my opinion. So yeah, that's pretty much it. Okay, so now stepping onto the subject, the 1 minute time frame, I got asked a couple of questions kind of regarding how do I trade just with the 1 minute time frame, or if I do see everything on the 1 minute time frame, if I use any other time frames and stuff like that, and if I would dive deep into how to take trades onto the 1 minute time frame. And for me, the 1 minute time frame, I chose the 1 minute time frame because on an intraday basis, you can find a lot of opportunities. A lot of opportunities, whether it is to the buys, whether it is to the sells, and we're talking about if I get up just to 7 a.m., which is not that early, and we trade until 12, which is something that I kind of do. Sometimes I just leave early. We're talking about 5 hours where we have 300 bars. And let's see, so let's look at this sells. Right here we had a buy, right? We have buy right here. Pretty simple buy, although it could have been a little bit complicated to actually find it. But basically we had a buy. And we had another buy right there. So we have this buy, right? Have this opportunity. Let's see how much did it take to actually form. For me, a trade begins to form when we start to see basically a potential area where price could basically react from and basically go to. So basically, where will we enter and where will we actually targeting? So in this trade, we have that the target would have been these equal highs, which is liquidity, and the entry is this, right? So let's say we count from this all the way until the entry. How much time did it take to actually create that entry? And that was 15 bars, which is literally 21 bars. My bad, 21 bars, which basically is 21 minutes. And the take profit will basically took 4 minutes to actually achieve target, but that's not quite what we're trying to illustrate here. So we took basically 20 minutes to actually find a new entry. Now let's see from this take profit, how long did it take to actually give us an opportunity to the other side of the market? It took 51 minutes, 52, all the way to the entry. I mean, if we count from where it generated the order block or the entry area, it would have been 52, right? No, actually, this is what causes this to be an area. So 53, we're talking about a 1 minute difference, so that's not that much. So we generated a whole trade in 20 minutes and to the upside, and then we found another opportunity to the downside in just 50 minutes. So 50 minutes later. And the same thing here, right? So for me to take a trade, I've said this before, and basically I need a flip, which is this. Flip is something that I will talk about in one of the sections. I don't know if I have already talked about it. But basically a flip is we have the break of this high, so this becomes our new high, which basically makes this our new high low. When this higher low is broken, we basically change from demand to supply. And when we do have that flip, that's basically in this case should have been a demand to supply flip. So that's a flip. And basically, this is our flip. The next I wait for is a break of structure. If I want to take a trade just with a flip, this structure should have reacted to something, right? Sometimes, let's say I didn't like this trade, right? If I didn't like this trade, then I'm going to have to wait for another break of structure and then for price to come back into this area, right? Which is a new potential area of rejection. So basically, for me to take this, to take the flip itself. Not the flip itself. Well, yeah, the flip itself, it should have been something like, I actually don't know if I have the example here. Well, I mean, do we? No, because this is a flip, this is a break, this is the area, so no. Well, this is the flip, but then we do have breaks. I don't think I'm gonna find an example that fast. Well, here, actually, as an example, we do have a flip because this is a flip, whether we like it or not. Sorry, this is not the one, this flip. So we're pushing lower, right? We know, I suppose, I think, so the order of the videos, I'm recording them separately, and then I will put them together, but I still haven't figured out the order that I want to put them on. So basically, I don't know if I have talked about flips and the band zone, so that's why I'm explaining this again, or for the first time in the video. So basically, when we're pushing higher highs, high lows, sorry, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Basically, when we change from that, this is a flip, right? And if we then break this again, then this is another flip. It's as simple as that. I mean, and then we could break that, and that's a flip, and then we can break that, and that's a flip. A flip is just that. It's as simple as that. I mean, when you change from a trend that is going high highs and high lows, and then changes to lower lows and lower highs, then you have a flip. When you have just a break, as an example, here we have a flip, so we're already creating lower lows and lower highs. Here we have a break, and that means that it's just a continuation from what we had before. This is just a lower high, then we have a lower low, then another lower high, we have a break, so another lower low, another lower low. As simple as that. So here we have a flip, right? As you can see, this low is broken by this movement, so this becomes our new lower high, and this our new lower low, right? So this is a flip. What happens next is price flips again. This is a trade that I took. That's why I'm trying to illustrate with this one. So if we check to the left of basically trying to find an area of reaction, or why did this react to that, we don't really see anything clean. I do like this area as an example, but it just, let me use something cleaner. It doesn't actually work out, as we do nick the high, even though it's just a small reaction. That's more than enough for me to basically say that this area is not actually the area that I'm looking for. So basically, I don't count that as the area I actually reacted to. I could even count this one as an example that we have back here, which is just this. But as an example with that one, the issue is that we have already mitigated the 50%. So it's a little bit useless. Not useless per se, but it's not common for price to actually come back and mitigate that. So as an example, this area for me is already mitigated by this, so I'm not quite looking for that area to work again. So if I was looking for an entry, I might would have gone for this, but I would have not gone for this, as I do see this as mitigated already. So we basically do break, and as we have been pushing lower, and something that I mentioned on one of, I don't know, this week's videos, markups and stuff, when you have a push like this, that you're pushing higher and higher and higher, I don't expect price to, let's say, react to this area, right? I don't expect price to do that. I expect price to basically just break all of that structure and break the low, which is what ended up happening. And I talked about this, I think it was on Thursday, yeah, here, where we had this huge structure that basically had an impulse, correction, and when price starts pushing lower and breaking all of these lows, I do not expect price to stop at any of them. I expect price to basically just break the whole structure, all of the lows that you see, and probably even the major low, basically. So I don't know why I was talking about that. Trying to remember. Okay, yeah. So basically here we have a flip up, and we have a flip down. Did it react to an area? We could say it did, but at the same time, I don't really think so. But for me, as we are pushing lower, and I don't think there's any reason for price to actually stop at any of these areas, I am looking for a sell. So even though we only had a flip here, we didn't actually have another break. As an example, if I would have waited for the break, the flip and the break, I should have waited for something like this. This is our break, right? Okay, I can read it right there. And price then comes and mitigates the area that causes that break, and then we have the continuation, right? But in this case, just a flip for me was more than enough. So yeah. Okay, another question was, do you base your trades on the 1 minute time frame only? And I do. I mean, I do. Sometimes what I end up doing is checking the 5, for example, to, let me actually get back with replay here, because we're going to be moving it around a lot otherwise. That's not what I meant. Okay, so sometimes I check the 5 just to see what's going on, right? Because this move in the 1 minute maybe didn't make much sense. But if we look to, let me move this. If we look here to the left, we actually have the price, this high that we have right here, reacted to this area. And if we check to the left, we see that that area actually caused a major break. This is, I mean, I didn't even think about this example, to be honest. I just checked to the left and I saw that there was something. And we even have liquidity, which is aiming at the 50% of that area, which basically price comes up, takes the liquidity, takes the order block, and then begins to fall. Right? So I'm not saying that you have to have every area on the 5, on the 1, on the 3, on the 15 mark, because otherwise we will have this one, probably this one, the high one, probably extreme one. I mean, I could go on and on and on. I mean, and at the same time, basically just on this push up, I would have had this one, this one, this one, this one, all of the ones that we have there. But basically, when you see a reaction, when you see a flip, you can go look what happened and basically find that. So do I use other timeframes? Yes, I do, but I don't base my trades or anything with other than the 1 minute time frame. I use the 1 minute time frame only, and I do pretty well with that. So yeah, I am looking to going back to what I used to do though, based on lower time frames entry and higher time frames targets. But I currently base myself, as I said, well, basically on the 1 minute time frame, and sometimes I look at the 5 minute, 15, 1 hour to look for potential areas where price could reverse or react to continue in the higher time frame direction, but that's every once in a while. I don't see a need to actually use the higher time frame, but I do think that if you do use it, you'll have an advantage over those who don't. As an example, me, of course. Another question that I got about the 1 minute time frame was if it wasn't all noise. So basically, if you check the 1 hour, 16. I mean, if I gave you the task to realize what time frame are we in, and I showed you this screenshot, and then I went to the 1 minute time frame, and I showed you basically this screenshot, you wouldn't be able to tell the difference. Sorry. You could say that this is the weekly. You could say that this is the daily, the yearly. There's no yearly candle though. The 1 minute, the 30-second. Seconds are actually a little bit more. They're a little bit more crazy, but still understandable. And the answer to that question is no. I don't think it's all noise. But I do remember a time where I couldn't understand anything in the 1 minute. But now, no. I mean, it's actually not noise at all. Sometimes you won't understand some structure, but that also happens within the 1 hour, the 4 hour, the daily. Happens in every time frame, basically. Sometimes price is just not cute, not pretty. It just does what it has to do, and it doesn't look good while doing it. And that's something that price does. As an example, this structure that we have here, there's nothing. I mean, there's nothing that I can really do here. But when we start looking at each move, we here, so if I don't have this, if I don't have this, if I don't have this, I don't have this, if I don't have anything drawn, if we have, let me actually hide it. If we have it like this, we don't really understand anything. I mean, I don't really see the trade right there. I have to have those marked or drawn, however you want to call it, and you'll find out that actually having those drawn and keeping in mind every single detail that happens through every candle or through every move, you realize that that noise is actually something pretty understandable, but you just have to put in the work to actually understand each detail that you basically encounter, which basically allows you to do that, right? To be able to find trades in a structure that you would have missed by not keeping in mind those details, right? Because sometimes people don't see this as a break because it's just wicks. And to be honest, I didn't until a while ago, a couple of weeks ago. And then I started to say, well, the low was broken, whether we like it or not. It's not that it has to close below. It's not that it has to do much. If it breaks it, then it's broken. There's nothing else to say about that. So yeah, with no drawing or not understanding what do you actually see or have, you are going to miss out on opportunities. But looking at every detail and stuff like that, you will find the opportunities that maybe you are missing out, just that are going out, that are basically happening right in front of your face, basically. Why did I choose it? Actually, so I've told this story a little bit. When I was in Phantom, trading. I was for a month. Then my subscription ran out due to my economic situation and my country's economic situation. It's not that easy for me to get $75. Was in that case. Now it's 80. So basically couldn't afford it, and basically had to leave and continue to improve on my own. And I think it was a couple of weeks later where I started to see screenshots and basically charts of Phantom members, that were uploaded to Instagram, stuff like that, that basically showed that they were traded on the 1 minute time frame, but with basically the same stuff that we were using on the higher time frames, right? So before, my way of trading before was something like this, right? So you will be in the 1 hour. You have, as an example, on the weekends, I will do the analysis of the whole market, which is the top-down analysis. I'd say this is an order block, so when price approaches that area, I could go down into the 5 minute or the 1 minute and look for entries, right? So the same thing that I do on the 1 minute time frame, exactly the same, but applied towards areas of like this one, right? Like the one that I'm showing, which is a 1 hour order block that basically caused this flip. And we could even have this one, this whole area as it is, and that one actually worked out pretty well. So we could go right now. I don't think this is going to work out pretty well, but we basically have that area. We replay to that. We go down into the 1 minute time frame, and we could try and find an opportunity, right? What I spot here is that we broke. Now we flipped. Now price is going lower. If it breaks as low, then we have another flip. I don't really like back testing. I said this before. Actually, I'm going to say it on the psychology phase, the psychology part of the video. So now we have a flip. Price has gone pretty low into the order block. We could go back and see if there's any area of importance. For example, we have some order blocks. What I do like to see though is this liquidity. I will talk about liquidity too in this video. Have liquidity right here, and we basically could have, so my drawings are actually fucked up right now, so that's gonna look bad, but I don't really care. For example, we have that area which basically takes the liquidity and basically an extreme kind of an area. And if we go back, price actually reacted to that, so it's pretty good reaction. This is not an entry that I would have taken just like that, but I will wait for more confirmations right now. And we can see, I mean, if I wanted to take a trade right now based on this structure, I might go for this candle as it is on the 50 or the 25, depends. Plus it is kind of creating a little bit of liquidity right there. We do have a break there, so we could have looked for an opportunity to continue to go higher, but we'll see what happens. It's kind of coming back to extreme, which is not a structure that I quite like. And after reacting to that, so look at this. We have a break right here. Have a flip, V2S flip. And no, not a flip, sorry, just a break to the downside, so that's continuation. So right now we could take this trade just as it is. Probably would have gone for the high for that whole candle, and so what if the 25, because going for such small areas might not be good enough. And what I would have kept in mind though is that order block down here, not order block, sorry, but that week as price can basically go about those areas. As you already know too, I don't like going for higher stop losses than 4.5 pips. So this is a trade that I probably would have missed. And my usual stop loss will be just below that area, but we do have that huge wick that we do have to keep in mind. And in this case, it does work out. As you can see, we didn't get tied out. Price did try and hit something inside of this candle. What we also could have done is just like this, keep in mind the 50% of that, and basically aim it like that, and I would have been triggered out basically. But yeah, and I'm not really sure why I'm actually doing this. What was I talking about? Oh, so yeah, this was basically my way of trading, and as you can see, it actually happened 6:55 a.m. So it's actually an area that would have actually, this could have been a trade, sorry, that I could have actually found through just, trading through the day. But yeah, that's the way that I used to trade, and I do kind of want to go back to that, not entirely, but basically just having those areas in mind in 1 hour, and basically, as an example, this area, let's say we have a 1 hour order block right here, or something like this, and this trade could have been aimed towards this order block that we have right here, and that could have actually given me a 15-hour instead of the usual 5-hour that I go for, right? So that's basically something that I've thought about for the past few days. Actually, I haven't really thought about it, but I do kind of want to implement that in the future, as I am just basically getting used to trade this way and actually getting some profits, right? So yeah, I think that's all that I really wanted to talk on the 1 minute time frame material. So yeah, that's all. Let's get to the next part of the video. Okay, so now we're going to be talking about, I was asked to talk about day in the life and my way of trading. I think those two kind of correlate, so I might talk about them both together. I'm still not sure what to do, but let's start with my way of trading. Day in the life, I did talk only, I have thought about talking just about routines, so I don't think my day in the life is really that that important, or something that you would actually be really interested in. So yeah, we'll get into that in a second. So how do I trade? How do I base my trading on? And it's like right now, when I actually started doing this script for, so let me actually show you the script for everything, right? Everything that I really want to talk. I went for smart money. So where do we have supply and demand? Supply and demand. We have this right here, right? So I do kind of want to get into that, but I still haven't done that video. I've even been, I mean, you have the tabs here. I've been researching about those kind of stuff because there are a couple of things that I actually realized that I don't even know where I got from. I don't really know if I got them from Phantom or I got them from other academies, because I've been in probably 10 academies. I've seen free courses of other academies. So basically, there are some things that sometimes I just realize that I'm doing, and I don't really know where I got them from. It's gotten to a point for me that I don't really know why I do something, but I just do it, and it has worked for me, right? So I basically trade based on structure, liquidity, ranges, and order blocks. That's what I mostly base myself on. Why do I take a trade, or why do I not take a trade? Well, this depends a lot, and sometimes it's hard for me to explain some of this, as I end up doing it out of logic or habits. Sometimes I don't take a trade because I'm identified a type of pattern that actually will go against me, and sometimes I don't trade it as I spot there's liquidity against me, which can be a bad choice. And what I mean with that is that sometimes we can actually have, what did I do? Okay. Basically, sometimes I actually do have an example here. No, where was it though? I think it was here. So what I mean with that is that sometimes we are not going to take a trade because it has liquidity above it, and yeah, it's as simple as that. I mean, you don't take a trade because you see liquidity above it, which means that price could actually go just above that area to take the liquidity, and that actually ends up fucking you up, and this is not working great. So here's an example. So let's say we actually decided not to go for that area. Let me try and find a way. I actually messed up and everything is multiplied. Let me actually show you. See, I don't know how many times, so yeah, I'll probably just delete the whole day. But basically here we have liquidity, right? You can see that we have liquidity. And considering that liquidity, what we expect is for price to actually go above this area, let's say mitigate this order block, and then push lower, right? In this case, I actually did decide to go for that area somehow, and basically ended up getting a good profit. Sometimes price will just go above it, mitigate, fall, and sometimes it will just, as it did, react to this area that it has liquidity above, but it basically just, I don't know, didn't care enough or something, but basically as simple as that. It did work. Okay, can't really do much here, so let's just hide that. And let's go back to 8.7. Yeah, I didn't really need that. So, coming back to this. Okay, yeah, so that's why I take a trade or why I don't take a trade. Sometimes, so I got asked if I need liquidity to take a trade. That was probably asked by someone that was in Phantom. And no, I don't. Liquidity is what moves to market. So waiting for it is actually a good choice, right? To take a trade based on the fact that there's liquidity supporting that move, but I don't wait for liquidity to form. If I'm hesitating a trade, right? Let's suppose, see if there's actually somewhat of an example. So let's suppose this one actually worked. Let's say I am hesitating taking this trade, but we do have liquidity right here, which are somewhat of just liquidity, right? Liquidity. And how do I, yeah, that's not the one. I thought control said, let's go back, okay. So we have liquidity here. So right now, this area is actually pretty good for me, right? That's an area that I would actually go for because it has liquidity just below it. As simple as that. And if we didn't create liquidity and price will start to change structure and actually start pushing higher, then that's probably something that I would just avoid trading. Let's say I didn't like this area and I would have probably still not liked the area as we never really created any clean liquidity. Although we do have some sort of it. It's just not that clean. I'm trying to find an actual example. So let's say this area, right? So the move right here, the move is not strong, right? Because we do have a first strong impulse. Let me fuck that up. We do have a first good impulse, but then we start to consolidate within the range. Within this move down that we have, right, between this cell. So when we are right here, I don't like it. I don't like the way it's moving. I don't like the things that could happen next. I just don't like it. But when we create that liquidity, just like that, when we create such clean equal highs, that for me is an entry. And this is actually an entry that I basically ended up placing. Of course, as you can see, I didn't get mitigated, and then I deleted it when it passed a lot of time. But basically, just as simple as that, a trade that I didn't entirely like because of how it was moving, we then get liquidity, and that changes everything, right? Because I think there was an example, yeah, here. So look at all of this liquidity, equal highs. Look at what happens when price goes there, attacks that liquidity, and pushes lower. It's as simple as that. Of course, this is a somewhat of a major move due to the fact that it is a major liquidity pool, and you don't expect the same to happen here. It's not that it's going to tap that liquidity and then plummet, right? It's not going to fall 3,000 pips. It's not going to fall what this one did. How much? 40. It's going to fall a little, right, as it is liquidity, but it doesn't mean that it's going to cause, it's just as simple as this. Let's say you are in the 4-hour chart and you see some liquidity. Let's actually try to find some liquidity. Did that high? No. Did this one? Kinda. Actually see that. So I think if we actually go to the daily, it might look better. Trying to find something a little bit clean. Okay, so we do have something here. So it's somewhat of an area more than just liquidity as we might spot it. But basically all of that is considered liquidity, and price came up and plummeted down. And well, in this case, it was 795 pips, but of course in a 1 minute time frame you don't expect that, right? You don't expect 700 pips to fall out of just a 1 minute order block, right? But basically, that's what you wait for, right? So I don't wait for liquidity, as I am not that kind of a patient trader. I'm actually the type of trader that basically wants to trade as fast as possible, which is not that good. But I'm just not patient. Not patient. Of course, I do wait for trades. It's not that I don't take a flip. I don't take a trade just because we have a flip. I do wait for the break, even though it could be a minor break. It's more than enough in most of the cases. But the thing is that, yeah, as simple as that, right? I just don't wait for liquidity. It's just not something that I quite like doing. If we do have liquidity in our favor, then that's great. I'm not gonna complain about that, of course. But if we don't, then I don't see that how do you call it? I don't see that that's that important to actually not take a trade because he didn't have liquidity. So, what are my steps to take a trade? And my steps to check a trade, I think I've actually mentioned them a lot, and is the fact that I need a flip and a break, right? Sometimes I need more, sometimes I need less, and it entirely depends on what we have. So, as an example, here we have a flip, we have a break. I placed this buy, I just didn't get triggered. Then we have this move. We do have liquidity, as you can see right here. Actually, let's delete this. That's liquidity, right? Equal lows, simple. And let me put it like that. Okay, that's liquidity. So we have liquidity right there. We do have that this order block. This is an order block because it caused a break. So that's the first big thing. And the next thing is that this move that we have here that was caused by this broke this major structure, right? So that's just a lot about this area, and that's why I like the area. And if I remember correctly, I went for the 50, maybe I went for the 25, but either way I didn't get triggered. So we had liquidity. The area was important because it caused a break, and it caused even major breaks, and basically, as you can see, it worked out. So the steps for me to actually take trades are more onto what are the setups that I trade. I think I can teach you more showing you drawings of how I trade, because I think just talking is just, I don't know, not much that I can really show you. And let me actually do it here because I can use drawings such as this one that we have here. I do have to edit it, I think. Yeah, okay, let me just do it like this. Maybe a little bit thinner. Yeah, okay. Yeah, simple as that. So the first type of setups is major breaks, right? I have them in my notepad here, that's why you might hear me far. So major break is something like this. If some structure breaks this high, well, that's not a thing. Let's actually look for something a little bit more important. We could call that a major break. I was actually going to draw it, just looking to see if I can find actually something that looks good. Well, this one here is a major break, and it does break it right away. We do have a reaction to that area. This is actually where we just were. Major break, this is a major break. Simple as that, but yeah. Here's the thing, right? Let's say we have something like this. Just like that. And then we have this, right? We have flip, have a break, another break right there, blah, blah, blah. And then we have something like this. It's like that. And then we do this. Okay, so all of the breaks that we have here, this is a flip, right? Because we were doing lower lows and lower highs, and now we changed from lower lows to lower highs to higher highs to higher highs and higher lows, right? Half break, not break, etc. Even with this one, right? These are minor areas. These are pullbacks, and they, as I said, I do count this as a flip because structurally it is, but it is not a major area. It is a flip, but it's not a major area. Now, if we look higher, this is a major area because look at the way it retraced compared to this, right? We have a big retracement and a big impulse compared to this small retracement and a small push, right? So for me, that's basically major structures. If sometime it gets broken, that's major break, right? What I drew here, sorry, is somewhat of a range. A range or a pause for me is just that price ranging, grabbing liquidity, creating orders, whatever it is you want to call it. Let me do it like this, and basically just generating liquidity. And if you actually see here to the left, we do have liquidity right there. This one bottom in this case, and price takes that liquidity and starts to push higher, right? So major break, this is an S1, this is setup 1, type of setup number 1, major break, and my entry will be on the cost to that major break. What I mean with the cause is maybe this is the whole move, right? And that whole move is caused by this extreme, but sometimes we just have a small pause right here that causes that major break, and that's my entry, right? In this case, I would go for this, unless we do have a pause, as I said, because we basically see that this low was created and even took liquidity, then broke structure. So this is somewhat, I mean, this is already a trade, a risk entry, right? Risk entry, but a trade. And basically, that later breaks structure. So my entry in this case will be here, but my stop loss, if I were to trade this, I hate that it changes the fucking color. If I were to trade this, my stop loss will be just below this low, right? Because price can easily come back and mitigate something inside of this area. Maybe in the 15 seconds, there is a pretty good order block or something like that that basically just wasn't mitigated and wants to make mitigated, and price just comes back, mitigates that, and then continues to push higher. And target will 5R unless we were using the higher time frames to target something. But in this case, I'm just doing the example. So that's kind of setup 1, right? That's the type of setup 1, type of entry with major break. And the other one is continuation. Okay, let's actually illustrate it with this one. So a continuation trade actually could be considered this that we have right here, because we are trading because of the fact that we have a major break. But whenever it's something like this, right? So here you have the first mitigation, here you have the second mitigation, and if we were to trade something in the near future, and if we wanted to go for this, this will be the continuation, right? This is setup kind 2. So what we will wait for will be for price to just continue that way, right? So let's say we have this mitigation, then we have something like this, then we have that break, and price comes back to that, and then we have something like this, blah, blah, blah. Price mitigates that. All of this, all that we have here, all that we have right here, etc. Everything that is going to the current direction is a continuation trade. This is as simple as that. You try to find any confluences that lead you to believe that price could respect an area. Basically looking for trades in the direction of move, and I consider that as continuation, as simple as that. And this will be continuation. This entry will be based more in major break, but yeah, and this is continuation right here. And if price were to mitigate this, that will be continuation. Then we have reversal. So let's do with this same thing. Reversal is what we have here, right? Price division lower, we have a flip, mitigates, we have a break, and my entry will be here, right? Or the cost, because sometimes the cost can be just here, right? Price could come back down there and mitigate that and basically give us a pretty good profit. Sometimes you do have a pause there and price just goes to the extreme. I mean, I'm not saying pauses and ranges are miracle makers, but yeah, simple as that. So that's basic reversal. Is see if we, let's say this major break didn't actually work, which sometimes can happen, of course. We have something like this. When we have this change of trend, sometimes I don't wait for I don't wait for the break. So my usual entry will be here, right there, this one, right? So we have the first one. This is something that I would miss. And we have the second one. This is the one that I would go for, right? As this is the flip. This was. And this is the break. So that's why I would go for that second entry. But basically, the reason why I would go for this is because we had such an important area that caused such an important break, but yet the the strength that the supply had at this point was enough to break all of those areas. And basically, even though we had so much confluences, or even though the demand was showing so much strength, right? So this is my entry, right? Even though we only have a flip, this is my entry. As simple as that. That's why I said that it's not that I trade so systematically. I do, but at the same time, you do have some exceptions at some points. As an example, because I say I only trade when I have a flip and a break, and that's not actually true, because I sometimes just wait for a flip. Sometimes, yeah, it's just that it varies a lot on the situation. Then we have last, but not the last one. But we have the type S4, which is complex pullback, which could actually be considered this one. So let's call it. Let's say we didn't have this major break, or I just didn't identify that as a major break. And what basically for me a complex pullback is something like this. So sometimes you see that price is pushing lower. This is a complex pullback right here. Price is pushing lower and strongly, and out of nowhere it starts to basically range a little, then it breaks and price comes back to mitigate something in there, and then continues to fall, in this case that I'm showing right here, right? That's a complex pullback for me. Let me actually find something a little bit more understandable per se. Kind of want to look for something pretty that's not that simple. Do have something here, but I don't know. It's somewhat of a complex pullback too. Well, this is a complex pullback actually. So, what are complex pullback? What is a normal pullback? Let's begin with this. Even this is a complex pullback in my opinion. This is not. So complex pullbacks for me, you either have a couple of choices. The first thing that could happen is that price starts to retrace, basically changing trend. So let's say we have this move, right? Right here, after this break, we have that basically demand is no longer in charge and supply has taken over, right? So what you're basically expecting is for price to continue to push lower. As simple as that. There's nothing else to consider. But when I was basically watching this, I was not looking for sells. Or was I? I actually think I was. But basically, what I'm trying to illustrate here is that even though we are in a complex pullback, we could try and sell something, right? Even though we know that the higher probability is that price will continue to push higher. So basically, complex pullback is that. So let's see a normal pullback. A normal pullback will be this. Push, pushes down, push, pushes down. Normal pullback, this. Maybe this, yeah, this. This is a complex pullback right here. So we have small pullback, then strong pullback. It even changes trends as we do kind of break that high. So yeah, it's not necessary for it to actually break, cause a flip, but it is good that it does because, well, it creates liquidity for basically to create liquidity for this buy. So why is this a complex pullback? Why would let's say I took this entry right here, I would call it a complex pullback based trade, right? And that will be because we are currently in a sell scenario, right? and I'm trying to buy, first of all. And why am I trying to buy? Because we have an important area here. This pause before break. So let me actually show you this. We have liquidity here. So this is somewhat of a sponsor candle. Then the break to this move, which could be considered as complex pullback because it took liquidity, but yeah, not that much. We do have a break caused by pause, so that's a pretty good area. Do we have liquidity? No, I mean every low is liquidity, but I don't like to consider it that way because otherwise we have liquidity everywhere, and we do have liquidity everywhere. Don't get me wrong, but I like to find that liquidity that is actually, I don't know, more clean or more obvious, like such strong levels such as these two levels or these levels or these levels I have right here, etc. So complex pullback is basically price. Let me draw it because it'll be easier for you to understand the drawing than my talking so much. Is this? Let me actually do a whole new one. Is when you have, so let's say you were pushing lower, and then you begin this. You have something like this, and this is the complex pullback, okay? So we have something like this, and then boom, we break that. And when we break that complex pullback, when we break the high that began, where that complex pullback began, sorry, that's a major break, and that's our entry, right? The cost to that major break could have been here, could have been here, could have been in the middle, could have been whatever it wanted to be. That's my entry. So it's a complex pullback. That's what I consider a complex pullback. I would love to show you somewhat of an example. And I did want to, well, this is a complex pullback. So the range, it is somewhat of a range. The range does cause a major break just before it begins to range. So it's something like that. So we basically have somewhat of a range. We do have small liquidity there, not something that I quite like. Then we cause that major break and price comes back to mitigate that. But I would like something a little bit more clean, even though that's pretty clean, not gonna lie. Well, this is a complex pullback. I mean, everything that looks complex is just, as I said, there's some things that I just say that make sense in my mind because I'm used to it. And well, this is a complex pullback. I mean, major. Of course, in the moment, we're not thinking about it as a complex pullback, as it does look like a change of trend due to the major breaks that we have had. But when we do break lower, then you're kind of looking at that like a complex pullback, and that actually worked out. This happened on spread hours, reason why market behaves so disgusting. But basically a complex pullback and shown causal break, and that's pretty much a profit target. So I think that's all about complex pullback. So I have setup 5 and 6, but I haven't really worked that much on them, so I won't be really talking about them. And I did wanted to talk about a trade that I actually missed out on, which I don't really remember what it was. I think we may have the the drawings and stuff. No, it's not the one. That's not the one either. I think it was yesterday. Sorry, today. Today? No, it's yesterday. Yeah, here it is. I can't really go back, can I? Why can't I go back? That's interesting. Okay, so this is actually a type of pattern that I've seen a lot. Not a lot, but I've seen it at least 4 or 5 times the past few days. Not few days either. So this whole thing could be considered somewhat of a complex pullback. But the thing is that the way it develops is just as simple as that. You have somewhat of a break Price then consolidates a lot, creating some liquidity that mitigates that and continues to push higher. That's literally what we have right there. And the liquidity that I mean is that one that we have right here. And I placed this trade, if I remember correctly. I think this was the one that didn't mitigate me. Yeah. How could I forget this one? When I saw, so I wasn't convinced about this trade. As I said, it's a pattern that I do recognize, but I don't have on my trading plan because of the simple fact that I haven't seen it that many times and I haven't studied it as much as I would like to. But we basically end up having some liquidity, and that's when price just basically convinced me and decided to place a trade. I placed a trade, but as I said, well, that's here, but I mentioned on Telegram, I showed the screenshot and said that I basically missed out on that. Beautiful profit. And in this case, it took liquidity, this small movement that we have. This is even considered a flip, right? Because of the simple fact that this low makes this high higher than this one. So that's higher high, this is our higher low, and that was broken. And so this is a flip. This would be considered a flip, and we have an entry right there. So, yeah, crazy stuff. I have seen it a couple of times, as I said. But yeah, I didn't entirely like it at the beginning because, as I said, it's not something that I have actually seen that much, and I really want to study. I do really want to study patterns before I include them in my trading plan or my setups. And this one, I don't know, I really liked it. And this will be setup 7, as I do have setup 5 and 6, which setup 5 is something like this, which I don't want to get into much detail because I don't entirely know it to call it somehow. So we have something like this, liquidity is created, and we have major breaks, and price basically comes back to the extreme and continues to push higher. All right, so what will be my entry? We have flip, break, entry, right? This could be my entry. Sometimes, but I mean, most of the times actually, that's not a trigger. So we have something like this, and then it continues to push higher. But the thing is that I've seen it so many, well, not so many times, but I've seen it at least 10 times on the past few weeks. And I don't know, it's something really cute that I've seen. So that's pattern 5. And then we have 6, which, let me think if I recall it, because I kind of don't. I really don't. So pattern 6, I saw it the other day. Let's see if I can actually find it. And that's why I kind of remember it. But setup 5, I drew it. I think this is the one. No? I don't know. So I had drawn them on my whiteboard. I got a whiteboard on my wall. And I don't know, I don't really remember where I drew them. So like, I'm kind of trying to find them, you know. Yeah, this is basically setup 7, although it'll become setup 6 unless I actually find setup 5. But basically, yeah, that's basically how I trade. I think I've talked. How do I analyze to take a trade? Let's say I get into the market. Let's say Friday wasn't that much of a given day. But basically, I get in the market, I have this, I identify ranges, I identify major breaks, I see that I have a range, so this could be a trade. I don't like trading this kind of ranges just like this. If we do cause a major break to the left, but if it's close, I mean, if we go 10 years back, I don't really like it, right? But basically, if we do, because let's say we have a high right here and that range causes that break, then I'm definitely going for that. But this one, as an example, didn't actually work, didn't actually mitigate anything. This is not something that I like. I do see that we have a break. This is a potential area, but not something that I like. So I just continue to see, identify these single highs. So this is a complex pullback. I identify this as a complex pullback, and we even have the fact that these lows that I have here, actually mostly this one's, I don't know why, in this main bottom, basically is liquidity. So that candle took liquidity, which means that it's a sponsor candle, and we then have that break. So complex pullback took liquidity, so that's a pretty good trade. I think I placed this trade, but just didn't mitigate me. And then continue to go higher. When I have somewhat of this structure, I just wait for new structure to be created. So example, when we have such such a strong push, I wait for it to react to an area. So this one is an example. And if we do have a break, then I could go for that confirmation. As an example, here the break didn't happen, but the confirmation I think does work out. Yeah. And then we do have a range just before this major break, which this, so let me actually show you something. Where's my drawing? Okay. So this that we have right here, which I said that I was waiting for the break right here to then take that, that's the continuation type of trades, right? So that's set up too. But at the same time, when we do have that that major break, when we do have that major break that comes from mitigation, stuff like that, this becomes a complex pullback. This whole thing is a complex pullback. And it's the same thing that we have right here, complex pullback, right? So I really hate that I can't control set stuff, probably because I have this, but I don't know. So when we do cause that major break after complex pullback, it's as simple as that. This is an entry. This is the cause just before that major break. Sorry, the cause to that major break, the range just before the major break. And again, that was not a mitigation. And then we have that pattern that, well, let's call it S6, basically, or that great. But yeah, sometimes you have one pattern, you realize, okay, so we mitigated this. If we break, we do have some liquidity here. It does come back to get them, but it never really broke, so there's nothing we can do. We trade based on patterns, not on what we like. Sorry, not on what we do trade on what we like, but we have to follow those patterns, those steps. Otherwise, if we did take this and if we didn't have that break, and this one went lower, then that would have been a loss that wasn't justified for. As simple as that. And that later fucks you up mentally. So, not mentally, psychologically, because, well, you took a trade that you didn't have the reasons for, and you will be like, well, why did I take that trade if I didn't have the reasons for? And well, that's when you get into that that loop that you have to figure out how to get out of. And the best way to do so is to trade based on technicals, right? So I will talk about something like this on the psychology section, where I'll say that basically people say that you can't trade with emotions, and that's very true, and also very false, because of the simple fact that we are human. We are based on emotions, right? So there's no way that we can actually take out emotions. I feel anxious when placing trades. That's something as normal as anything. And I feel happy when I take a win, and I feel sad when I take a loss. That's something that I probably won't ever change. It's something that you can't really change. This is something inside of you. But what you can change is to take it out of the trade, because on my step following type of on my trading plan, basically, when I have a trade, I have a couple of steps that have to happen, before a trade, before I decide to place a trade. And of course, I don't put in there if I like it, right? That's not one of the steps. If I like it, or if I feel happy, or if I don't feel nervous about this trade. Because that's where you gotta remove your emotions from your trading plan. Your trading plan has to be technical, has to have steps that you have to follow, and that will give you the highest probability on a trade or on a movement or anything, however you want to call it. But it's not the same than just removing emotions completely, because that's actually not possible. So kind of went out of subject there, but yeah, they wanted to talk about that. So I think that's all about how do I trade, right? And let's actually do the next one now, which is someone asked for day in the life, and I don't really want to do a day in the life. That's not that interesting, but I do want to talk about routines, right? So how do I trade, or when do I trade? I sometimes get up for London, right? London for me is 4 a.m., so that's way too early. For me to get up at 4 a.m., I should go to sleep somewhere around 10. not 10. 10. No, 10 is 6 hours. So I really do know that we need to sleep at least 7 hours. So I kind of try to do that, so I would have to go to sleep at 9 basically, and that's a lot. So I don't do that. Um, so yeah, basically I wake up 5 a.m. when I try to trade London, sometimes 4, and I sleep less. And after I trade a little bit of London, sometimes I catch some movements, basically very early. And if I catch two take profits on London, I don't trade for the rest of the day. It's as simple as that. If I get two take profits without any losses in the middle, that's as simple as that. I do not trade more. It's more than enough. It's a 2%. So I would just quit. I still do watch the charts, as I love watching the charts and predicting stuff, but I don't continue to trade because two take profits is amazing. So that's for me more than enough. So yeah. So I wake up for London, I trade a little, then I go back to sleep, then I wake up for NY, right? I wake up for London Open, so I wake up somewhere around 6 to 7 a.m., which is 2 to 1 hour and a half before New York Open, right? So I mostly trade NY, basically. A little bit of London and NY full session. Of course, depending on what we have. Okay, sorry, I had to make a little bit of a pause there. So, I'm not really sure where I dropped it, but basically had I basically trade a little bit of London, and I most of the times end up trading in a white full session. So, okay. So what else do I do about trading? Of course, through the day. After the day is done, so that's basically 11:30, 11:30, 12 in the morning. I basically get up. I don't stay on the computer that much. I go, I have lunch, I stay a little bit with my family, live with my family. And after that, what I do, I come back to the markets, to the charts, and I basically do the markups. I check everything that I did right, everything that I did wrong, what did I miss, why did I miss it, how can I see it the next time. Is it a type of pattern? Is it something that we already have seen, or what led me to miss this trade? What led me to lose this trade? What led me to win this trade? Right? That's all that I do. I check out what have I done right, what have I done wrong, and basically I try to keep up with that, and just try to be aware of the mistakes that I've been doing, the mistakes that I've things that I can improve, things that I gotta continue doing as I'm doing, and basically that. As simple as that. That's what I do on basically post market scenario. I got asked to do a back testing session. I don't really do back testing. I don't really like to back test that much. I will talk about it on psychology because I do have a small section for it. And but yeah, I do back test every once in a while, but I don't like to back test as much as I used to. And that was actually mostly because I couldn't pay for TV Pro due to issues that I have with my CC. But I actually bought TV Premium. I think it was today or yesterday actually. So basically, I will be back testing, and I could add a clip or two of me back testing, showing some of my thought process, but not a lot, as I don't really find it that interesting to show, as I will mention it on the psychology area. Um, what I want to see in a trade to take it. I think that was one of the questions that I had. And I think I did talk about it, and I don't really need to see that much. I need to see intent. I need to see the confluences that I wait for the most. I would love to see some liquidity, but that's not something that I really wait for that much. Also, sometimes the liquidity that I actually like the most is when the area that I am going to take the trade on actually took liquidity. So as an example, since we're here, this one right here, we basically created these equal lows, went higher, creating this equal lows, took those equal lows and then broke, right? So, and basically, well, we didn't cause that, we basically had that entry as it is a sponsor candidate. I will even create a liquidity just before the entry, so that's even more confluences. But yeah, simple as that. I mean, I don't really wait for liquidity, but if it's there, then great. It's more confluences. So yeah, routines. Well, on the weekends, I actually let me actually show you, if I can, without showing a lot. I have Notion. I really that recommend for you all to get Notion, which is free, by the way. It's not something you have to pay for. Oh, I actually have it here. So, since I bought week 3, this is week 3 of June. I still have to do, well, actually, week 4. So you can see it's actually a typo. I actually do have to do the July 1st and 2nd weeks. I'm a little bit late on that because I'm in college, so I've been a little bit behind on these past few weeks. But as you can see, so at the end of the week, I go through every day. I draw, sorry, not draw, but I basically have my markups. Okay, let me zoom in a little bit. I do my markups as well as I can, and basically show why did I take what, why did I miss what, which did I take, yeah, stuff like that basically. So I don't know. It's just I think it's something pretty important to do, and having all of that, I can go just to, let's say, April. Yeah, let's go. Yeah, April, week 4, and what happened in each loss. Well, I don't think. Yeah, I do have a couple of them. This one, and I explain a little bit why, and this one too. Apparently, only 2 losses. This was the time when I wasn't trading that much. I wasn't executing that much. I was actually backtesting more than anything else. But yeah, I'm not sure why is this not loading up. Let me try again. Okay. See, so basically, and we have the steps. Why did each happen? This was the time when I was actually going to for 1 to 10, 10 hour, 10 hour, 10 hour, 10 hour. Of course, probably most of these weren't actually taken. But yeah, that's what I like to do on the weekends. And on the weekends, of course, I also, well, I actually used to do the higher time frame stuff. So I just analyze the market. Let's say I go to 1 hour and say, okay, so we have another block here, we have another one there and stuff. And basically just drawing potential areas of rejection, as simple as that. No, not much more than that. But yeah, those are basically what I do, or my routines, or my day in life. It's nothing more than that. And I'll see you on to the next section. Okay, so now continuing to situations you can encounter, we're going to be talking about ranging markets, impulsive movements, ranging trades, no trades for a while, I'm missing on trades, and basically what to do in each case, or that's what I basically decided to talk about here. So we'll start with, I have a script here, so I'm gonna kind of read that, and then I'll basically add a little bit of information that I may come up with in the moment. So yeah, the actual question I got here was what to do when the markets are ranging, right? And in the moment I thought, well, you leave the markets, right? There's no need for you to be every day, the whole day, not the whole day, of course, but the whole session just watching price, right? It's not healthy, and it's not the objective of trading, right? Because trading is supposed to be something that doesn't require as much time as an actual job, right? Where you have to be 8 hours or more, like in certain situations, basically just away from your family, away from basically away from freedom, to call it somehow. But yeah, so so if we have a ranging market, we have to ask ourselves, where is it ranging, right? Are we in an area where price could react and it's basically taking its time, creating liquidity, basically executing orders? What's going on? Why is it ranging? That's the first thing that you gotta ask yourself, because you have that this is a range, but at the same time, this range is approaching this area, and when it mitigates that area, then that falls. As simple as that. But sometimes you'll have something like this as an example, where you range and just you ranged in nowhere. I mean, maybe we had something back here, which I don't really think so, because we did take this, And basically we have range, as simple as that. In other cases you'll have something cleaner. For example, this is a range within an area, although price does weak the high, so not quite something cool per se. But yeah, that's the first thing you gotta ask yourself. If we're ranging in an important area, then that's good. If we're not if we're ranging basically nowhere, well, that doesn't say that much about price basically. Look at this. A little bit of a forecast for GBP dollar. Just like this, have an order block. Price has, so that order block has liquidity just below it. We have equal highs there, so this order block took liquidity, mitigated that high, so it's also continuation. So price could basically be going up there. So if we got a SPY right here, then we could be aiming for that area or just above that liquidity. But yeah, that's not what I'm here to talk about. So the next question that you gotta ask yourself is, what time frame is it ranging on? Because a 1 hour range has infinite opportunities in the 1 minute. So I really don't care. I actually love when it's ranging on higher time frames. Now, if it's ranging in the 1 minute, it's pretty rare. So it doesn't happen that much, and when it does, it doesn't last that long. So if I actually do go to the 1 minute time frame, and I mean, there are dozens of ranges. There are small ranges, there are big ranges. This is a range right here. Can I do Control Z? No, because it doesn't. I really don't understand why. Okay, but yeah, this is a range. This small thing is a range. This whole thing is a range. This is a range. This is a range. This is a range. And actually, there are ways to trade ranges, right? There's a range, this in movement, and then price comes back to mitigate that range, as that range, based on some strategies or some concepts, you believe that a range is basically something that generates liquidity and makes the market move, right? So as an example, this range was ranging basically to just generate liquidity to then create this impulse, and price then came back to execute some unmitigated orders or something like that, right? So yeah, as simple as that. Those are ranges, but basically the 1 minute time frame ranges don't last that long, as you can see, unless you look at it like this. We could consider this whole thing as a range, right? As it doesn't move that much, and then it does generate a big impulse. But at the same time, it's not quite what we're doing, because the 1 minute time frame, we have to be looking at what's going on. This is a range, and as you can see, it did last a little bit, right? But it ended up doing its thing, which is just a range, and then we have a movement post range, basically, right? So yeah, simple as that. So what happened when you don't encounter trades? That's something that we might all go through at some point, where you are just sitting there with your hands, sitting on your hands, basically, that's the phrase, and you're just not encountering trades, and that's actually pretty common. And that, of course, depends, because it can be on you, as it can be on the fact that the market is just not giving opportunities, which is pretty rare, not gonna lie. You can see opportunities every few minutes. Well, not every few minutes, but yeah. I mean, if you think about it, there are millions of people basically trading the market, and there are millions of strategies. So every move is tradable, right? Whether it is to the upside, whether it is to the downside, whatever it is happening, is this oh god, this small move can be traded, that small push can be traded. And of course, there's something that this phrase, I read it on Instagram. It's the fact that we do know that every move is tradable, but the fact that we know that not every move is worth being traded, what gives you a little bit of an advantage, because of course you can try and trade every move that you have, but that doesn't mean that you have to. Every move is tradable, but that doesn't mean that you have to, as not every move is as good as others, basically. So yeah, I got out of topic there. So I don't have higher time frames showings, so I do this whenever I'm having issues and I'm not seeing trades or missed out on a couple of trades. I just delete the whole chart and start analyzing it all over again. But doing it thoroughly though, marking every detail, every break, every reaction, what areas were left unmitigated, which areas are of interest, where could I look for a confirmation entry, etc. And that actually gives me food to find out what I was doing wrong and why did I miss out on a certain trade and etc. Right? It's as simple as that. Keeping that in mind, sometimes you will realize, as an example, when was so in this, you see that July 9, which was Friday, you never really found, we never really had any opportunities any clean, sorry, we didn't have much opportunities, but we did have this trade that we have right here, this one, sorry. We did have this trade, which is a little bit hard to find, could have been easier to find this one. So you do have opportunities to take trades. This is a beautiful trade, although it barely mitigates the high. But basically, it's pretty hard and uncommon for the market to not give opportunities. That's what I'm trying to illustrate. So if you're not finding trades, then it might be on your side that you're not finding those opportunities to basically cleaning the charts and restarting again, checking every detail. You might encounter those that you were basically missing or were happening right in front of your face, right? As simple as that. So impulsive markets. What do you do when you have impulsive markets? If you've seen my videos that I've been posting through the week, or if you're part of my Telegram, you probably already know that I do what I do when the markets are impulsing without retracing, and I basically wait for patterns I've seen, patterns I recognize to trade either in continuation or against the trend. I always keep in mind strong areas against this impulse, just so I can spot somewhat of an early flip that might not look that strong without the area in mind. So it'll be like something like this. So we do have this impulse, right? And let's say that this is a strong area that I am keeping in mind. And if we do get a flip here, then the flip on its own, it's not that important, but the fact that it flipped up after tapping in an important area, then that changes the whole perspective, right? That gives you that you have a flip after tapping into a bullish BOI, right? AOI, sorry, area of interest. So yeah, that's what I meant by yeah. So basically, when the market is impulsing, which is what we had on Friday, I keep going to the monthly. When we have such a strong push, as an example, the other day I said that when we are pushing so much since the beginning of the day, sometimes we will see a strong and long retracement that might come to mitigate somewhat of an extreme area and then continue to that higher higher area that price could be looking for. But basically, what happened here is price didn't want to stop. I mean, price was just going higher, and I didn't have any kind of intention to continue to just retrace, right? So when you have a market like this, a more impulsive market, what you have to do is just wait patiently and analyze every single thing. This is a range, so this is a complex pullback. We break out of that range. What was the cost of that break? It was the that range before that major break. Have another range right here. The cost of the break of that range was the extreme, so that's an entry. And that's what you look for when you have an impulsive market. You can't. I'm mostly used to trading stuff like here we have a reversal. So this is the flip, this is the break. That was caused by that. So this should have been my entry. We've incurred liquidity, but it doesn't. It barely taps the high, and as you've seen on the week, I've missed out on a couple of them just because full price didn't mitigate me. Then we have a range. Break. This could have been a trade, a little bit risky as we don't really break much if I remember how I checked to the left. But this trade that we have up here, this one right here, worked out amazingly. And as simple as that, when you have impulsive markets, you wait for continuation patterns or the patterns that you've recognized worked on an impulsive market, or basically just trying to find that continuation. And that's as simple as that. I mean, there's not much else to do. Sometimes I am kind of always looking for somewhat of a reversal, which is not the good thing, as price could easily just continue to go higher and you're missing out on profits while you're still looking for a reversal. Yeah, I mean, it depends on how you want to trade and stuff like that. Whether you want to trade only, counter trend trades or pro trend trades. I hope that's understandable. But yeah, let's go to the next. So missing trades. When I miss out on a trade, I mostly behave the same as I do when the market is impulsive, basically. So you either wait for price to come back and tap the confirmation entry, or you wait for the other type of structure or setups to develop, right? So if we go to the example that we have right here, let's say I missed out on this trade. What I could have looked for is this other area, right? Which was the cause to this break. And then we do have another break. And then we do have another break, right? So when you start creating a new structure, you start to basically analyze what's going on. So as an example, when we do have this liquidity, aim into this order block that we have right here. Although the 50 is actually not mitigated. My entry could have changed from this to this because of the simple fact that we have liquidity here, right? So yeah, that's as simple as that. I don't really want to get into much detail with that, but basically, when I miss out on trades, I do exactly what I do on impulsive markets, as I am kind of looking at a impulsive move that happened just a second ago, and there's not much that I can do until I either price, as I said, come back to trade again here, or unless it changes the trend or we have any familiar pattern that we've discussed already, of course. So that's all that I have here for this subject. I don't know if I think that was all. So the actual question was, what to do when the market is ranging, right? So it's as simple as that. When the market is ranging, it's probably because it's not probably. The market goes in one or the other direction. It will always go higher or lower. It can't go to the right nor to the left. To the left is to the past, so there's no way you can go to the left. So what I'm trying to say here is whenever price is ranging, it's because it's getting ready to go to one of those directions. And it's your job to basically identify which direction might that be and then start to analyze accordingly, right? If you're expecting so here, as simple as this, right? If you have an impulsive move, you have a range, impulsive move, range, impulsive move, range, impulsive move, range, impulsive move. All of these ranges that are inside of a bullish move, all you are expecting at this point is for that range to just generate liquidity and then continue to push higher. When you have, let's say, 4 hours like this, 1 hour is like this, 15 minutes like this, 5 minutes like that, 1 minute like that, that's never gonna happen. There's no way that all of them look similar. Not similar, but look exactly the same. Because if the 1 hour is looking like this, then the 1 minute is looking like something like this, right? So you have sells, you have buys, you have sells, you have buys, etc. Right? So that's what I was trying to say, but yeah. So when you have a range, price is getting ready to move into one direction or the other, and it is your job to basically. You won't predict, because it's worthless to predict in this case, because you have the range. Price is going to go to either direction after that range. What you do is that after that break, you try to find the entry, and which is most of the times basically the cost to the break of that range, right? It's as simple as that. That's the only thing that you can do on ranging markets. As I said, if you're in the 1 hour and the 1 hour is ranging, well, the 1 minute has So let's say these are 5 candles. Well, that's 5 times 60 to get the amount of candles that we have on the 1 minute time frame, that the 1 minute time frame is doing something like this. So you're getting tradable and a tradable scenario compared to what you have on the 1 hour, right? So it's basically that. And yeah, I think that's all. I gotta record psychology to the next one. Okay, we're going to be talking about markups now, and the guy or girl, I can't really say for sure who it was, asked me, what's going on? Okay, so I was basically sent the response of markups. As simple as that. I don't know if the person wanted me to talk about them. I don't know if the person wanted me to share markups here. Oh, okay. Yeah, I kind of know what I did here. Oh, that sucks a lot. Is there a way for me to Control C this? Like all the way back? Because I don't really think so. Oh, no. Well, okay, let's use another date then. 8th of July. So, basically, markups. Markups are, I think, a pretty important thing to do, right? Because we have, okay, so here's the thing, right? They're important. They allow you to review your chart. Everything that you can watch or rewatch or replay, everything that allows you to see the mistakes that you've done, the trades that worked, the trades that didn't work in a detailed manner, helps you a lot. As you learn from mistakes, as you learn from action, as you learn from everything, right? So let me put it like this. Having the markups or doing the markups, you're basically seeing what happened. You can see which trades worked, which trades didn't, the reasons behind each one of them. Do you see the value on that though? Like, this is a repeating market. It does the same thing over and over. And knowing what has happened means knowing what could happen. And I didn't say what will happen because you will never know 100% sure, and that's very true. But trading patterns that repeat themselves means that you can basically get profits. Of course, if you trade the patterns that work, right? Because if you trade a sell pattern and you buy it there, then, well, I mean, you might win every now and then, right? But I think you get that. I think you get my point. Okay, so I started doing them very recently, not gonna lie. And what I used to do before was check on the weekends what had I done wrong and what had I done right, and basically base from that what can I change, what should I change, and what's basically what needs to be changed and what needs to be updated per se, right? So, but that means at the same time that you have to wait a whole week filled with mistakes instead of just doing that every day and fixing it for the next day, meaning improving each day, which also means that if you, let's say you made 2 mistakes today, because of, I don't know, 2 mistakes, just think of 2 mistakes. The next day you go and you did those 2 mistakes and let's say an extra 3 ones, and then the next day you do 2 more and stuff like that, and at the end of the week you basically end up doing 10 mistakes in a day, and that's not good. That's not good at all. But the thing is that doing markups every single day allows you to realize, okay, so I messed up because I didn't keep in mind the other side of the market. Okay, I messed up because I didn't keep in mind that we had a potential reaction to this area. I messed up because of this, I messed up because of that. So basically, markups are for you to basically self-teach yourself, right? So teach yourself. So I kind of want to do an example, but I can't really say for sure how. Okay, so let's talk about this right here, right? I probably put this note that we have here right when it happened, right? So what it says is deleted this order as I wasn't into the buy, and the only reason why I wanted to take the sell was because I was taking the buy too, right? So in this scenario, I don't really want to get to explain, but I basically wanted to take a buy here and at the same time the sell because either one of them could work. So I basically decided to take the risk on both at the same time. What happened is that the buy didn't actually trigger me, even though it did tap it here on the trading view, but it didn't tap it on my broker, so it basically means that I missed out on that buy, right? And the next node that we have is we did have the confluences for the sells as we did have the confluences for the buys. And what does that mean? That means that psychologically, I basically screwed myself here, right? Because I should have taken both of them. I tried to take both of them. The first didn't trigger me, and as you know, when it does trigger me, but it doesn't actually trigger me, right? So we do have the trigger here visually, but we actually don't get the trigger on the MetaTrader. Then that's basically when I delete the order, right? So I should have followed the steps as I usually do. So what do I get from this? What do I get from this markup? The thing that I get is, okay, so what do I need for a trade? I need a flip and I need a break. Did I have both of them? I did. Did we have more confluences? I didn't. Did I like the price action? Did I like the reaction? Did I like everything? We're mostly pushing lower. I mentioned about this structure. So we have a push down, correction, potentially a push down. So I was pretty sure that price could continue to push lower. And basically, we did have more than enough confluences to actually go for this, right? So why didn't I trade it? Psychologically, I stopped myself, right? So that's what I get from this. I had the confluences. I had extra confluences that I didn't really need, but I basically had them. And I just deleted the order because psychologically I didn't allow myself to. I do kind of have that rule that whenever I'm trying to take two trades, one against each other, if the first one doesn't trigger me, then the second one will be deleted. As simple as that. Because the risk is no longer the same. And in this case, it didn't work out. In some other cases, it actually helped me to avoid a loss or something like that. But basically, if we have the confluences to take a trade, you just take the trade. You don't base yourself on psychology. You don't base yourself on any other external factor. Let's say there's a crash in your block, right? So a bus, I don't know, crashes against a car. Will it really change or alter the way that you will trade? No, because it doesn't make any sense. And it doesn't make any sense. It's a weird metaphor, but I think you get the point. It doesn't make sense to not trade something when it has the confluences that it needs. And it's as simple as that, right? That's what this markup gives me. So the next day, I don't do that. Let's say the next day I have the most similar situation that I can get. Let's say the exact same thing happens, then I'm taking both. If the first one doesn't trigger me, then the first one is deleted, but the second one shall stay, right? As simple as that. That's the mistake that I get. Here, let's say I did take the sell. I didn't, but let's say I did. I took a loss here. What is the mistake? We are pushing lower. We do come from a higher time frame order block, which is not something that I really keep in mind, but basically I had them that day, so basically as simple as that. And what happened? So when we do realize that we have reacted to an area and we are kind of pushing higher and we do have confluences to take buys, then you don't take sells. You do have the confidence to take the sells, but you do see that trend is coming against you, and price has just reacted to a bullish order block, right? And well, you do have the confidence that I mentioned. So basically, right there, you just don't take that trade, right? Let's say we did get a loss. Okay, so we did have these confluences. In this case, we might get this same concept, like we should have taken the buy and the sell. So in this case, if psychologically we would have been okay, or would have basically done it right, why is the template not working? Okay. This would have been a 45, and target would have been 225. As simple as that. And at the same time, we basically would have gone for that cell right here. Right? As simple as that. If we didn't get triggered on the first one, then we don't. Then we basically just let the cell run. Right? As simple as that. We would have gotten a loss. Yes, definitely. But it is what it is. You're just trading technically. You're not basing your trading out of psychological factors or external factors to the market. Right? Here, well done. Flip, break, entry. Simple as that. Pause before major break, entry. This is not something that I took. This was I was psychologically scared. I just didn't want to trade it. I did like this area, I drew it and everything, but I just didn't trade it. I don't really like to trade those kind of passes, to be honest. But yeah, I think I do remember drawing this before it happened, but at the same time, again, not quite strong enough to actually take that. I was strong enough to take this. I wasn't strong enough to actually allow price to hit target, and basically did it. It would have ended up in a loss. But basically, that's why markups are necessary. They show you the mistakes. They show you the flaws on your trading plan, on your trading, on you, on your psychology, or on anything that you can imagine based. Not based, but related to your trading. As an example, we could call this a flaw on my trading plan, because I do have that thing where I say, okay, so I'm going to take the buy and I'm going to take the sell, right? And at the same time, I'm saying here, this sell I shouldn't have traded this sell, because we were reacting from a bullish shorted block, right? Do we have the confidence for the sells? We do. Do we have the confidence for the buys? We do. Then I should have taken both of them, right? So as an example, we could call that a flaw on my trading plan. And that's something that if it wasn't inside of a markup, or if I didn't realize somehow, just rewatching what happened through the day, I would have never found out, right? It's as simple as that. Markups allow you to realize what you're doing right and realize what you're doing wrong. You should do resumes of everything, right? Of every trade, every pattern that worked out. Here we could say, okay, so we had a flip, we had a break, then price basically kind of retraced like a complex pullback. For me, this is a S4 type of setup, so complex pullback type of setup. We have a break, entry on the cause, take profit. Simple as that. So did we do the things right here? Yes. What were the steps to it? These are the steps. Did we have the confluences? We had the confluences. Did we did what we were supposed to do? We did. Okay, nothing else to say. That's a good trade, just something to be proud of, not something to really analyze further, because there's not much else to analyze, honestly. So to conclude, I didn't expect this to take that much. They are important because they show you your mistakes, they show you the setups that happen, they show you what you could have done better, they show you each and every single detail of the day. And of course, your thoughts. Something that you could actually do also, such as this one, is take both. Is add notes to the price action, just like this one's, and say, okay, so I didn't trade this, or I did trade this, or I am curious about this. I think I've seen this pattern, and you just start basically having all of those notes all around your chart, and what you basically have to do later is come back to them and basically say, okay, so I thought in the moment that I saw this pattern before, so let's look for it. You start looking for it, you realize that this is a pattern that have repeated itself, I don't know, maybe let's say 10 times on the past few days. And for you, that's enough to add it to your trading plan. So you study it, you see how it forms, what it happens before, what it happens after, and you basically, just like that, have another pattern or setup that you can look for through the day. So simple as that. That's why markups are important. Okay, so the big one, psychology. What no one mentioned, no one even thought about. What most will likely avoid, just like I did. I'm not gonna lie, just like I did when I was at every academy I ever was. And you have no idea the things that you can achieve with just psychology. So let's get into it. Although I do have to mention that at the end there was a person through IG that did through Instagram that did ask for it. So well done for her or him. So yeah, I'm going to read a script. I probably will later mention something else as I've been doing. I have no intention on do something while I'm reading this whole thing. It's a pretty large thing, but I might end up posting somewhat of a back testing. Uh, yeah, just a bit of back testing while I talk about psychology. Okay, so you can get into any and every academy there is. You can spend months with a strategy, watching videos, backtesting, talking to other students at the same academy, but you might not find that consistency that you need, that you want, and you desire. So for me, I'm going to put myself as an example here. For me, it was like this. I knew the concepts. I backtested. I watched the videos. I got up every morning and nothing was happening. I couldn't identify the traits. I couldn't hold good traits. I couldn't be consistent. When backtesting, I wouldn't get the best results, right? But I would get some positive outcome. I'd spend 3 to 4 hours backtesting in some other occasion and still will get the same results. So we're talking about, let's say, I got 9 losses and 3 wins. So that's up by 1%, but that's not the scenario that we're looking for. That's not that consistent, and I wanted more consistency. So I knew the concepts, I was aware of what I was supposed to do, but yet my psychology wouldn't allow me to do my thing. So what changed? What can you do? What's the best path? And to be honest, I do not think I have the correct way to answer that. I still struggle on a daily basis, on a psychological way. I miss out on good traits, I miss out on losses, I feel scared to take this or that, and it's clearly not something that I've come to master just yet. But I do get profits. I have a list for the past few weeks, been getting profitable weeks, so that's a lot to say, not gonna lie. And it's a lot about trusting yourself, trusting the strategy, trusting that it works, having the mental strength to wake up every day knowing that it might won't be a good trading day, but you'll still get up, take the trades. Losses for me are learning sources, right? And wins is just something to be proud of and have in mind. I sometimes say that you don't learn much from wins, which is pretty much true. And it's basically based on the fact that you actually did the things you were supposed to do the way you were supposed to do them, right? But at the same time, it helps you realize which patterns worked out the most and the losses, which patterns didn't work out. But yeah, I'm basically getting out of track there. So the thing is that you have to get up. You have to take the traits that you are scared to take. You have to realize that the only way to learn is by taking action. You won't lose the scary emotion when taking a trade. That's not possible. But you'll trade being scared. Doing the things that scare you makes you stronger. I think that's something pretty basic, but it is like that. So I'm going to use an example here in just a while. But you can spend weeks, you can spend months, maybe planning, getting ready to get onto the markets. And that's fine. I'm not saying that's bad, but you have to realize that until you're not right there in the second that you have to take a trade, in the second you have to place the order, tap that sell limit, place the correct lot size, the correct stop loss, the correct target. The thrill, the feeling you get on those few seconds between analyzing a trade and placing it, those you won't get from backtesting. Those you won't get by looking at the charts after the day has passed. Your emotions are not present when backtesting, and that's why what I don't really like about backtesting. People say trading has to be emotionless, and I agree on a 200% basis. But we're human, and humans are based on emotions, literally what we live for and by. So there's no way for us to actually remove them. It's not a switch. It's not saying, okay, I'm trading, I'm emotionless now, right? So it's as simple as the next. You will feel bad when you take a loss. You will feel excited when you take a win. You will feel anxious when price doesn't move. You will feel anxious when you place a trade. You will feel while trading, and there's nothing you can really do about that. So what is backtesting for? It's just a little bit out of topic, but I did feel the need to actually get it here. So backtesting is for finding and testing patterns, recognizing steps before a trade works, finding your way through price, learning what to expect and what to not, and recognizing new patterns, adding them to your own trading plan, etc. So it's basically, it works, it's there so you can see what happens, what could happen in the future based on what happened in the past, and basically start realizing about these patterns, about these moves, or somewhat of structure way that the price moves. And that's what backtesting is for. That's what I've used backtesting for. Now, what's demo trading for? Demo trading for me is backtesting but with emotions. You're there in the moment. The market is literally alive right in front of you. Anything could happen, price could fly up or dive down. Your entry could work as you may not even get triggered. You have to place a trade besides your emotions. You have to have the balls to place a trade, because even in demo you feel that anxiety when taking a trade. By executing, you learn in first hand, because you can watch 1,000 videos of carpentry, read 20 books about it, but whenever you get your hands first time to the wood, the hammer, and the nails, those thousands of videos and books are literally nothing. So watch videos, read, learn, watch other people's trades, look at markups, do your own markups, expect the market, do all that, but at the same time execute. Try everything new you learn, and this will help a lot to your journey, that I can assure you. So that's what I basically had for psychology, and it's basically that. So psychology was for me a huge wall that I had to overcome, because it was something like this. I'm currently on a challenge, on Funding Talents challenge, and I'm on profit. I'm somewhere around 3 point something percent, and I have to achieve an 8% profit. And here's what I did just before buying FT challenge. I would have my alarm at 5, and so I will get up to basically analyze the market and try to find opportunities, of course, by trading on a demo or just a spectating price. As simple as that. That was my how do you say this? My objective for that 5 a.m. alarm. So whenever I get up, wake up, I will check Trading View on my phone, and I will realize that maybe an opportunity just happened, or maybe we are, we're in an impulsive market, maybe we're ranging, anything could be this scenario. And what I would do is, so nothing is going to happen in the next few minutes, so I'm just going to go to sleep. And whenever I wake up, I will backtest the hours or minutes that I was basically missing between the 5 a.m. and basically the time that I woke up again, of course. And by doing this, I allowed myself to believe that I was actually getting results, because what I would do is wake up, backtest the price action that I missed, and basically realize that, okay, I would have traded this, I might would have gotten this loss, and basically I will be up by 1%. And then through the day, when I was able to place the trades, I just wouldn't. I would just watch price and say, okay, so price could react here, right? It could react there, it could react here. So I think that price could easily react here, or that it could easily react right here. But I would not place a trade. And what that led me to believe is that, let's say I say, okay, so I do believe that this is a pretty good area for price to reject, or for price to actually give me a sell opportunity, right? I would say that I will be, I don't know, joking around, playing some games, watching YouTube, watching Netflix, whatever you want to picture yourself basically wasting your time on. And I will basically come back and say, oh, so I was actually right. I was right. Price did react to the area that I thought it was going to react to. And that's great. That's great that you are able to identify an area where price could react from. But that doesn't mean that you took that trade. That doesn't mean that you are profitable if you do this for weeks. You could do this for months. But just by saying, I think price could react to this, you're not doing that much. Sure, you are identifying those patterns, you're watching the market on a daily basis, you're getting used to being in the charts. But if you're not placing the trades, then it's literally nothing. Because when you actually get to trade, when I actually got to place the trades on my Funding Talent account, I just couldn't. I mean, let's say I had placed. So here's the thing, right? I mean, when I got to the point that I said, okay, so I do need to place trades, I will go with my demo, and I will be scared to take trades, even though I could say easily that, okay, so this is a pretty good area for price to react to, because I knew the concepts, I knew what I was supposed to do, but I was just not doing the way that I was supposed to do them, right? So it got for me to a point where I will get in my demo and I say, okay, so I missed out on this opportunity. I do like this area. So yeah, let's say it was something like that. So I will miss out on that first area. I would have missed out on that first trade because I was asleep or something like that. And then I will place a trade and I will trade the stop loss trade. The usual trade that it's something that probably has happened to you, that you basically get up, you see that two opportunities have already worked out, would have been a take profit if we would have been up earlier, and you take that trade, and that's a stop loss. And that's something that is probably, I don't know, for me at least it was common. But basically, what this caused me to believe is that, okay, so if I traded this, I can trade the ones that actually worked out. And that's kind of true, but at the same time, it doesn't work like that. Because when I got to my Funding Talent trading account, I wasn't scared to take trades, and I basically started losing. The first retry that I got was out of luck because they had an issue with the broker. If it wasn't because of that, I would have to repay for that challenge, and that's not easy money for me. It's not something that I can just get in. I mean, it would take me, I don't know, I haven't actually done the numbers, but it could easily take me more than 4 months to actually get that money. I do have a small job. I don't actually work. I'm at college, but yeah. The point here is that it got to me to the point where I will be scared. I would be scared to take this trade, and that trade worked. I will be scared to take the second trade, and that trade will work. And the third trade that I wasn't scared to take because I was right on the past two analysis, that's the one that I basically traded and got me to a loss, right? So what I'm trying to say here, just back testing, you can back test 12 hours a day if you want, but if you're not there with the demo account trading on a daily basis and realizing, okay, so I did like that area, I went for that area, but it didn't work. Okay, so why didn't it work? You start looking at the details. Okay, so it didn't work because of this, because of that, because of this, and that. Okay, so next time I try to avoid this type of patterns, and I try to get to the patterns that actually worked out. Next day, you see that the pattern that didn't work out yesterday is forming. So what do? You actually look at the other side of the market. Basically thinking in advance that sell that you took yesterday today is not going to work just as it happened yesterday, and you're actually looking for that buy, and you're actually ahead of the market. You're trying to be ahead of the market. Of course, you'll never be ahead of the market. That's something that's just impossible. but knowing that a pattern that is forming is most likely not to work, then that gives you ahead of who you were yesterday, and that's a lot. So psychologically wise, it took me a lot. It took me a lot because I had to realize by firsthand, by almost losing a challenge, that I couldn't learn like that, and that's when I got more disciplined. That's when I started. I went back to that back testing, to that basically having that mentality where I had to get up to get what I wanted. Had to get up, I had to trade, had to do this and that. So after the first retry that I got, I basically asked for that retry to be basically on a few weeks, right? I gave myself a few weeks to trade with the demo. And those few weeks were actually really good because those few weeks I was with my demo, I basically traded, I realized which mistakes were doing. If I would have traded with the funding, with the challenge account in those 2 weeks, I would have lost the account again, right? As simple as that. There was no way for me to actually get profitable because I took a lot of losses. But it was something progressively. The first week I lost, let's say, 20 trades. The second week I lost 15. The third it was 10, and the fourth was, let's say, 5 trades that I lost. And of course, the winning trades through those weeks were getting higher. Of course, let's say the first one just got 1 day profit, and on the second one I got 2, the third one I got 3, 4, and the fourth, I got maybe 5 or 6, right? So having that mind, that change, where I realized that I had to put on more hours, is what basically helped me, and what basically is actually allowing me to, well, be here today and be doing pretty well with the challenge. At least for now, of course, never know. But that's psychology. Psychology in every aspect that you can imagine. It can either help you out a lot, or it can literally just ruin the whole thing. Psychology is a bitch. Psychology is a bitch. You either get a hang of it as soon as you can, or it will basically push you around until you realize that you have to get it under control before you start risking money on the markets. It's as simple as that. Psychology is key in this profession. And yeah, as I said, I am not master that thing just yet, because I still do feel scared to take some trades every now and then. But every day that happens, every day that I'm present, every day that I place trades, every day that I realize about my mistakes, every day that I realize about the things that I did right that day, everything helps. Every little bit, every loss, every win, everything helps. Whether it is by a little or whether it is by a lot. And yeah, I mean, honestly, recording this video has been, I mean, if you check the hour, I think I was recording it at 3 p.m. or something like that. So it's been 6 hours between the last video and this one. Sorry, not 6 hours, 4 hours. But basically, it has been a lot, because this example has made me realize that there are a couple of flaws on my trading. There are a couple of flaws. Psychologically, I knew on my trading, at least on the things that I knew I was going to talk about, I didn't think there were any flaws. Of course, there are flaws, but I didn't think they were so a couple of flaws that, in my opinion, were a little bit too big or too important to be messed around. So I'm still developing, right? I'm on a beta kind of, version of my trader self, right? And it's just about being present every day, right? Every day you can learn something new. Every day you can make a new mistake. Every day you can make something new but better. Something new that actually makes you realize that you were doing something right, that you were doing something wrong, and that this new way is actually better. and you wouldn't have realized due to if you didn't have a previous mistake. So the thing is that, yeah, I think I've said what I had to say. To be honest, I I think it was a little bit shorter than what I expected. I thought it was going to be something like 40 minutes this section, but it's just basically that, is to not be scared of the market. The market will always win. Don't get me wrong on that. But it's about having the strength and being there every day. Even though yesterday you lost on the demo, of course, 1% or 2%, depending on how much you risk. And getting up that next day and still looking to improve. And knowing that someday or another you will get there. You will get to that place that you're looking for, which is, I think, what we are all looking for, which is consistency. And when you achieve consistency in a demo, you just have to do the same thing on the real. Not gonna lie, the change from a demo to the real, it is a pretty huge thing. Not gonna lie, but it's about keeping emotions up. As I said, you can't really keep emotions out. You're human. The emotions are what move you. But the thing that you can do is that on your trading plan, you don't have emotions. Your trading plan, for example, my trading plan tells me if you have a flip and a break, then you trade. It doesn't say, okay, so let's say you have a flip, let's say you have a break, then look at it, and if you like it, that's when you trade it. No, the emotions are useless in trading. Emotions are useless. I don't use emotions to trade, but I do feel emotions when I trade. As I said, I feel anxious when taking a trade. I feel happy when I take a win. I feel sad when I take a loss. I jump around when I end up the day profitable. My mood is different when I had a profitable day, and that's something that you will never be able to change. And I don't think that's something that is bad. But the bad thing is actually taking trades based on emotions. So let's say you had 2 losses. Oh my god, I can't believe I had 2 losses. I really need to recover the money. No, that's not a way to think about it. You don't think about it that way. Let's say I had 2 losses. Okay, so I had 2 losses. I don't want to finish the day in a loss. Let's just continue to look for opportunities. That's where the emotions comes in play. The emotions come in play. You either use emotions to trade, or you either use emotions to keep yourself trading. I don't know if I'm illustrating the difference, but the thing is that sometimes I've been on 2 losses in a row, maybe 3 losses in a row, but I've kept myself trading that day, and maybe I've basically managed to come back into profits. Which is what happened the other day. I actually had 2 or 3 losses in a row. I did do the markups, the video on that one, and I continue to trade. Simple as that. I continue to trade, and I actually found two pretty good trades that basically had that the things that I needed to take a trade. Had the confluences. I couldn't find the word. It had the confluences that I needed, and I traded both of them, and that got me from a loss of a 0.5, 0.75 to a win of a 1%. And of course, at the end of that day, I was happy as hell. I was as happy as I could be. That was the happiest day of my life. Of my week, trading-wise, of course. And it's just that. When people say you can't you can't have emotions while trading, I agree on them. I agree with them, but I don't agree on the fact that you can't trade while having those emotions, because that's, as I said, impossible. But what you can do is take them out of your trading plan. You have to trade basing yourself on technicals, not emotions. You have a flip, you have a break, you take the trade. you don't entirely like the trade because you don't have enough confluences, then that's something that's different, right? You don't like the trade, but that's because you don't have enough confluences, right? But if your trading plan says that a flip and a break is more than enough, then a flip and a break is more than enough. You take that trade. It's as simple as that, right? You have to remove emotions from your trading plan, and not from yourself, as not possible. And that really changes a lot. That really does change a lot. So I think that's basically all that I really wanted to mention on the psychology tab. I think it's the most important thing that you can basically think of, because whether we like it or not, trading is just another subject. It's like we're back in high school or college. You have a subject, you study it, you come to learn it, then you practice. At some point, you basically manage to know every concept just out of the top of your head, right? Um, but that doesn't mean that you can apply it, right? That doesn't mean that you can apply it. I mean, the carpentry example or metaphor, however you want to call that, came out of my head like out of nowhere. To be honest, I did want to use a metaphor to try and explain that, because it's something that it's not maybe that easy to explain, but it's just like that. I do believe 100% that um, this is a pretty good example of how studying against execution actually works, right? So yeah, I mean, it's as simple as that. I hope you all enjoyed the video. I hope you were able to get something from this. If you did, well, share it with your friends that might need it. And I wish you all a pretty good journey on your trading. I think the journey is the best thing, because whenever we are profitable, we will continue to improve. We will continue to find ways to improve our trading, but it'll be different. It won't be the struggle that we're having currently, right? This basically just trying so hard to find that consistency. Whenever we actually have that, and we will continue to then improve, it won't be for need completely, of course, but it will be more for improving ourselves, right? Just improving because we want to improve, right? That's not bad. I'm not saying that's bad. That's greedy, but greed, in my opinion, is not bad. Of course, greed on cocaine is not bad. It's not good. But greed on learning or improving in yourself is a totally different game, right? So yeah, I hope you all enjoy the video. I wish you all the greatest journey you can have. Keep up the work. Trading is hard. Trading is difficult. It's probably one of the most difficult professions that there is. And the easy path is to give up. But at the same time, the easy path is to learn to trade Forex, work between a lot of commas for a couple of hours in the morning, and then you have the rest of your day to enjoy with your family, to travel, to do whatever you want. You have to have dreams, because if you don't really have dreams or goals, then you don't really have a reason to live. So that's a little bit sad. So yeah, something to think about. So I think that's really all that I wanted to mention. I still do have to do the video on supply and demand, but I'll probably do that tomorrow, Sunday. So yep, that's all, guys. See you soon.